Okay, good morning, CalSTRS Investment Committee. It's great to see everyone. Happy March. It's good to see everybody looking happy and healthy. And I hope you are optimistic like I am that things will continue to improve day by day over the next few weeks and months. So this will call the Investment Committee meeting to order. Let's go ahead and call the roll.
Good morning, everyone. Mr. Keeley?
Morning, Scott. Here.
Ms. Bradford?
Here.
Ms. Hendricks?
Here.
Mr. Passant?
Here.
Ms. Erden?
Here.
Ms. Yamamoto?
Here.
For the Director of Finance, Ms. Miller?
Here.
For the State Treasurer, Mr. Saha?
Morning, President.
For the State Superintendent of Public Instruction, Mr. Yamanaka?
Here.
State Controller Yi?
Here.
Chairperson Higa, you have a quorum.
Great, thank you very much, Scott. So I just have a few administrative items before we start our meeting. The board will have a 10-minute public comment period at the end of each agenda item. Public comment after each item will be limited to the agenda item topic, and there also will be an additional opportunity for statements from the public for items not pertaining to a specific agenda item during the open session meeting. Individuals wishing to speak at the board web conference should dial into the public comment line, which is 833-986-0555, and wait in the call-in queue. Each speaker will be allowed a maximum of 3 minutes for his or her presentation. If there's not enough time for speakers to have 3 minutes, the timing may be modified at my discretion. Teachers Retirement Board meetings are live web streamed and video archived, which are available to the public on CalSTRS.com. To protect the privacy of minors who wish to address the board, public commenters under the age of 18 should only state their name and affiliated organization, but do not share any personal identifying information such as last name, age, or school. So let's turn to agenda item number 1, which is the approval of the committee agenda. Could I get a motion and a second to approve?
Approval. So move.
Thank you. I think moved by Sharon and seconded by Karen. All those in favor say aye.
Aye. Aye.
Great. Any opposed or abstentions? Okay, for agenda item number 2 is the opportunity for statements from the public. So we will take our public comment callers at this point, and I think we will turn it over to a member of our team, Samantha, to help us manage the callers. So Samantha, we'll turn it to you. Thank you.
Our first caller is Susie.
I'm sorry, Samantha. I realized that there were a couple of comments that I neglected to make before we go into public comment. So just one moment. So just kind of a recap, this is the opportunity for statements from the public, which is scheduled for 30 minutes. We're going to be splitting the time between callers, and comments may be made at this time that may pertain to topics that are not covered by a specific agenda item. Just so that members of the public are aware, we accept public comments in 2 forms, both verbally and in writing. Before we take the verbal comments, I want to summarize the written communications that the board received prior to this meeting or since our January board meeting. I believe we received 151 handwritten communications from the fossil fuel campaigns. So, members of the public who were interested in that particular item. So thank you. Apologize, Samantha. I'll turn it back over to you to start with the public callers.
Okay. So our first caller will be Susie. Susie, go ahead.
Hello?
Go ahead, Susie.
Okay, hi. This is Susie Chow, United Teachers Los Angeles, retired. And I want to say good morning and thank you all for all the work that you do on our behalf. Last month, all of us heard a presentation on China and investments. And it was a very interesting presentation, and I personally learned a lot about China's economy. And as I reported back to UTLAR, we don't know what your plans are in terms of investing in China, but we discussed it and we are against any investment in China due to their atrocious human rights policies. And we understand it is challenging to balance your fiduciary duties and to fulfill your obligations. But please consider this as you move forward in the future. We want to thank you again for all the work that you do, reading the reports, taking time away from your families, and just taking your responsibilities so seriously, which we really appreciate. Again, we do appreciate everything that you do on our behalf. Thank you.
Thank you for your comment. Our next caller will be Marge. Marge, go ahead.
Machipchis Kuchi Haima. My spiritual name is Sister Who Walks with Bears. My colonized name is Marge Grow Eppard, and I'm president of MMIWMP of California, which stands for Missing Murdered Indigenous Women and People. I'm informing you, we the Indigenous people across Turtle Island will stop every single pipeline you rip into our sacred Mother Earth. This is about our next 7 generations ahead of us. And we have millions upon millions of ancestors behind us, urging us forward. Raping yet again another female without any conscious thought, feeling, or remorse is an act of misogynistic, narcissistic, sociopathic behavior. The mentality is so typical of how corporations are continuously using subliminal messages on how this is the way to go for the future. If they truly want their grandchildren and great-grandchildren to have a beautiful future, let them be proud of how their elders saved the world with protecting everyone living in a sustainable lifestyle. How dare you use teachers' pensions to fund these pipelines? You have a lot to answer for. The world is waking up. We are standing with our brothers and sisters blocking line 3. Is CalSTRS really the fraudsters? We are rewriting history. Do you really want to go into the books as being corrupt? Social media is exposing you. You will be held accountable, especially for the missing, murdered, and Indigenous people. I have family and friends who are teachers, some of them 3 generations. They are shocked with what you are trying to get away with. When you want to learn what to do about stopping pipelines, sit with us Native Americans before it's too late. Thank you.
Thank you for your comments. Our next caller will be Jackie. Jackie, go ahead.
Hi, my name is Jackie Garcia, and I'm a mother of 3 children and a member of 350 Contra Costa, and we are a grassroots climate movement, and we are advocates for a healthy climate, a sustainable, clean energy solutions to the climate crisis, and environmental justice for all residents. I'm very proud that one of my children attends the University of California at Davis, a school, a very large university system that has fully divested from fossil fuels, and I urge CalSTRS to do the same. I read the CalSTRS position on divestment and fossil fuels, and frankly, I found the arguments in that nonsensical. It was pure Orwellian doublespeak. It seems to me that this position is straight from the marketing and branding of the fossil fuel companies. And, you know, if you can believe what they are telling you, that would be quite shocking to me with their long history of deceiving the public on climate change. This is akin to going to Philip Morris for information about the health benefits of smoking cigarettes. So as a mother, especially, the idea that we would be, CalSTRS pensions would be invested in something that is hurting our children's future, and it's hurting their health directly, as yet another study has come out that shows that air pollution has much more negative impacts on human health than previously understood. A recent Harvard study showed that 18% of all deaths globally could be attributed to air pollution, and this is from fossil fuels. You know, you're smart people. You are looking at investing money for a living. You know, this is what you do. And I think it's pretty clear that money drives change. And everyone knows this. We don't hang on to bad choices and ride them all the way down. It's kind of like a gambler's addiction. But that seems like what CalSTRS is planning to do with the fossil fuel companies. And we urge you, for the future of our children, to divest now. I urge you to do a listening session with the teachers who are calling for divestment, for the youth activists, and also perhaps with some financial advisors, such as the University of California system, and learn about their decision to divest. Please. Thank you.
Thank you for your comment. Our next caller will be Bill. Bill, go ahead.
Hello, is it me, Bill Vosberg?
Yes, go ahead.
Oh, good morning. My name is Bill Vosberg. I'm a retired teacher from Santa Rosa, California. I'm a member of Fossil Free California. And I call in today again to ask you to reconsider your staff's refusal to divest from fossil fuels. For the past 7 years, the CalSTRS staff has remained adamant that they prefer to engage rather than divest with fossil fuel companies. However, a recent study by Scientific Beta suggests that divestment, quote, can actually make the shareholder engagement more effective, unquote. They continue to say that, quote, removing the worst ESG performers from the investable universe concentrates the divestment on the ESG laggards and sends clear-cut signals to all companies and stakeholders. Thus, paradoxically, CalSTRS executives' anti-divestment stance and willingness, quote, not to abandon carbon companies, as we heard Mr. Ailman say a while ago, sends a clear but signal to ESG laggards across all sectors. Engagement without the threat of any action. The very real possibility that CalSTRS will invoke its divestment policy remains just talk. And we know that carbon companies are very good at talk. They've been talking about climate change since the 70s. So our policy of engagement gives carbon companies the license to continue their business as usual and destroy the planet. If the threat of divestment makes engagement more effective, and categorically ruling out divestment might be a breach of fiduciary duty. Mr. Enos, Mr. Ailman have been clear that the fund is at a significant long-term risk due to climate crisis, but their hard stance against divestment may decrease the rate of decarbonization across the sectors. Board members, you can dramatically improve the ability of CalSTRS to move the entire market toward decarbonization by overriding the position of Mr. Enos and Mr. Ailman. You have the incredible powers to revoke the social license of the fossil fuel industry, which is destroying our planet. Please reconsider your staff's refusal to divest from fossil fuels. Divesting will give you even more leverage than engagement. Thank you.
Thank you for your comment. Our next caller is Diana. Diana, go ahead.
Thank you. Good morning. My name is Diana Curiel, and I'm a CalSTRS member and a retired middle school science teacher. I'm very thankful for my pension and all the work that you do to safeguard it. Please safeguard our collective future by using divestment from fossil fuels as a tool. Your past response has been that you have a policy of engagement with fossil fuel companies in order to promote ESG policies and a low carbon transition. As you will hear, the engagement efforts have not been effective. Again, I urge you to divest. I reviewed your documents about engagement efforts with fossil fuel and energy companies. Your greatest success appears to be with Duke Energy and with American Electric Power, which have set 2030 and 2050 timelines for reducing carbon emissions, but do not reveal how these goals will be achieved. These were the only significant commitments which I found. On the other hand, an examination of the policies of some of your fossil fuel holdings indicates that any engagement efforts you have attempted with them have been ineffective. For example, you invest in Chevron Corporation, which applies so-called enhanced recovery methods to extract heavy oil in the San Joaquin Valley. However, the lack of regulations in oil operations has been affecting the health of millions of residents in communities of color in the Valley and LA for years. Over 70 California organizations and thousands of residents have supported legislation which will address these health and safety concerns by halting permits and requiring safety setbacks. How have you supported the years of efforts to regulate this industry and preserve the health of these communities? Your investments in Enbridge, ExxonMobil, Occidental Petroleum, and other companies are similarly problematic. We heard this morning already about Enbridge and Line 3. ExxonMobil, everybody knows about. People in Santa Barbara County are very upset about them wanting to restart oil platforms and to spoil the environment again as they did in 2015. In fact, you've been talking about challenging ExxonMobil in a conference this week. Jack Enos talked about it, but he sounded very pessimistic. He said, we're going to do it this year. I don't know if we'll be successful. Fiona Reynolds, a Climate Action 100 Plus steering committee member, said this: central to achieving climate goals is the setting of clear targets on how companies plan to move to net zero, as well as ensuring that they are transparent and held accountable for actions taken. So, CalSTRS, how will you hold these companies accountable? Thank you.
Thank you for your comment. Our next caller will be Paula. Paula, go ahead.
Hi, I'm Paula Buell. I'm a retired elementary teacher, and you have seen me in your boardroom and heard me on your phone lines before. Ever since I found out that billions of dollars of our pensions, my pension as a retired teacher, are invested in fossil fuels, I've wanted to make it clear that I don't think this is in our best interest as Californians, as teachers, and as retirees. At first, my biggest concerns were pretty basic. I knew that fossil fuels contribute to climate change. They imperil survival for people and living things across the globe. It just didn't make sense for my pension to support a climate catastrophe. Then I met the amazing, smart, committed, and impassioned young people who came to the meeting to share their concerns. Between meetings, they educated themselves so they could educate us. Now, as a teacher, I've always felt proudest when my students could lead the way in places where we adults have fallen behind. Through history, young people have often reminded us of what we failed to address, as they did at the lunch counters of the Jim Crow South and on the streets of Soweto in South Africa. I'm proud to lift my voice alongside theirs. My fellow teachers and I have learned that there is plenty of evidence in favor of divestment. CalSTRS engagement strategy isn't working. Fossil fuel investments are losing ground, and venerable institutions like the University of California and the New York State Pension Fund are divesting. The case grows stronger every day. Lately and belatedly, I admit I'm more aware of the environmental impacts of oil drilling and fracking on communities near them in our state. The children of low-income parents and communities of color are most heavily impacted. My thinking has returned to the basic moral argument. None of us wants our pension to be invested in making children sick and hurting our most vulnerable citizens. I am so grateful for your work to protect my pension, but it saddens me to hear that you've not met with students of color and teachers who live near fossil fuel sites to talk about environmental racism. Please honor their request to meet and put fossil fuel divestment on the agenda of your next meeting. I know you care about our students, our teachers, and our pensions. This is what CalSTRS is all about. You have the power to move us toward a clean future that works for everyone. Thank you.
Thank you for your comment. Our next caller will be Lynn. Lynn, go ahead.
Thank you. I'm Lynn Nittler, a retired secondary English teacher of 33 years. Thank you for my pension. It means a lot to me. You all know that the burning of fossil fuels is causing climate change, including the firestorms last summer that burned even our fire-resistant redwood forests. Last summer, Phoenix, Arizona reported 144 days over 100 degrees. Sacramento is expected to have a climate like that of Phoenix within this decade. We enter this summer facing a second year of drought in California, with all of our reserves abnormally low and warnings of more fires likely. The story would be the same on the East Coast, just substitute hurricanes and rising sea level, or in the Midwest, substitute floods. Think of what you know about climate disasters all around the globe. Yet, CalSTRS persists in funding fossil fuel companies whose only product speeds climate chaos and ultimately causes the death of our biosphere. That $6 billion CalSTRS dollars contributed toward our demise. By positioning CalSTRS as part of the problem, you miss out on opportunities to steer us on a new course into a truly sustainable and carbon-free future. If ordinary folks convert to electric energy, ride bicycles, and go meatless, it's simply not enough unless big players like CalSTRS step up to the challenge. We need big investments in solutions that are available but are not scaled up yet. Check back with Al Gore and David Blood, whom you once listened to with interest only a few years ago. Invite them back. It is possible to invest in a livable future for our planet and still make money for our pension plan. Be careful and diligent in your choices and choose to be part of the solution. Here's one more reason to get out of fossil fuel investments. Oil companies are notoriously irresponsible. They are ripping apart our lands with risky drilling and fracking techniques that use undisclosed noxious chemicals. They have no regard for where they drill because in California, we have never succeeded in passing regulations that other states have, such as a 2,500-foot setback from schools and homes. While California requires that oil and gas drilling companies seal their wells when they finish, in practice, they simply abandon them. Across much of California, fossil fuel companies are leaving these oil and gas wells unplugged. In my email testimony, I will send you the link to read up about the 35,000 decommissioned oil wells. Thank you.
Thank you for your comments. Our next caller is OG. OG, go ahead.
Good morning. I'm OG Strogatz with 350 Contra Costa. I ask that you commit to full prompt divestment from fossil fuels. The Climate Center recently stated that we risk exceeding the 1.5 degrees centigrade global warming threshold by 2030. 10 years earlier than the IPCC projected in 2018. When it comes to fighting the climate crisis, time is not on our side. Lots of organizations get it. As has been mentioned earlier today, consider New York State's pension fund with $226 billion in assets. The fund announced last December that it will drop many of its fossil fuel stocks in the next 5 years and sell its shares in other companies that contribute to global warming by 2040. The state controller, Thomas DiNapoli, long resisted a sell-off, saying his priority was safeguarding the retirement savings of 1.1 million workers who rely on the pension fund. His main reason for adopting the new plan was his duty to protect the fund and set it up for long-term economic success in a world moving away from fossil fuels. He had long advocated against divestment, but he changed his mind after ExxonMobil's rebuffs in recent years to the New York State Fund, CalSTRS, and other shareholders that have pushed for a greener business plan. Consider that in late January, 2 New York City pension funds voted to divest their portfolios of about $4 billion worth of fossil fuel stocks, or 2.4% of the $168 billion total value of the two funds, which represent city teachers and other workers. Consider that CalSTRS fund has been valued at over $240 billion, with about $6 billion invested in fossil fuels. A 2019 study by Corporate Knights reported that CalSTRS would have earned $5.5 billion more had it divested from fossil fuels 10 years ago. Consider that CalSTRS has a history of divestment for moral reasons, including divestment from South Africa to end apartheid and divestment from tobacco products. Declining to divest enables the fossil fuel industry, allowing it to continue to pollute in communities and lobby against meaningful climate action. It's not best for those relying on CalSTRS, and it pushes all of us toward an uninhabitable planet. Please divest now from fossil fuels. Thank you.
Thank you for your comments. Our last caller is Suzanne. Suzanne, go ahead.
Hi, and thank you so much. My name is Suzanne Hume, and I am the Educational Director and founder of Clean Earth for Kids and a member of CalSTRS. The important testimony we have heard today and that you have heard over and over again in the meetings and the written communication that you have received, people are asking you, people who care about children. This is why we became teachers in the first place. It is not okay to continue on the path that you are leading us down. I am very sad as a person who has spent my life in the classroom and worked with children on a daily basis to know that they are being poisoned because CalSTRS has not divested. Follow the lead of New York. Follow the lead of all of these universities, you know, California, and so many more, divesting. You need to do the same. You must divest from fossil fuels now. 1 out of 5 premature deaths in the United States is caused by fossil fuels. Burning fossil fuels creates toxic pollution that kids are breathing. How are they supposed to come to school and learn when they have a headache? And as you have heard, unfortunately, AB 345, the bill that would allow us to have buffer zones of 2,500 feet away from schools and homes, that failed. It's up to you, and this is your responsibility. In fact, as a CalSTRS member, you have no greater responsibility. So I understand and appreciate the other work you do, but I am just really surprised that meeting, month and month and month keep passing. And I'm thinking, how is it that teachers wake up every day and they go into their classrooms wearing masks and work online? Teachers are working hard and administrators are working hard. And it is not okay for you not to do this immediately, as in today. Meet today and make your plan for divestment. We must protect children's health. Thank you very much. We cannot continue to divest in fossil fuels. It is a racial, social, climate, and environmental emergency. Right now, we must divest. Thank you so much for all of you that are working to let the others know that this needs to happen right now. Thank you.
Thank you for your comments. That will conclude public comment for item 2.
Great. Thank you very much, Samantha. And thank you very much to the members of the public who offered your comments today. We all hear you every time you come to our meetings, and our staff will follow up with you appropriately as needed. So now we move to agenda item number 3, which is a consent agenda item just to approve the minutes of our January 27th and 28th investment committee meetings. Is there anybody that wants to pull this item or has comments? Okay, then otherwise, without objection, it's on the consent agenda, so the minutes are approved. Now we'll move to agenda item number 4. which is the second reading of our Sustainable Investment and Stewardship Strategies private portfolio policy. We had an initial presentation and discussion about this at our meeting in January. I just want to note for the record that it is this agenda item is scheduled for approximately 20 minutes. So I just ask that both our staff and our consultants and the committee keep that in mind. So I think at this point, I will turn it over to Kirsty to open up our presentation. I think as you'll hear from Kirsty and as you see in the meeting materials, they worked closely with both Makita, with Steve McCourt, as well as with Tiffany Reeves, our fiduciary counsel, to address some of the issues that were raised in our January meeting. So I believe that both Stephen and Tiffany are also available to the committee if there are any questions. Kirsty?
Great. Thank you very much, Madam Chair, and hello everybody, good morning. I'm pleased to be able to present this second read of the policy for you after the initial discussion we had in January. I'm going to run quickly through 6 slides that I have, many of which I shared at the last meeting, but I'm going to hone in today just on the additional changes that you will have seen in your materials from the first read in January and today. So if I could go to the next slide, please, Jonathan, or whoever is changing for me. Let's have a little look again to remind ourselves that what we're focused on is just the private portfolio component of the CIS program and portfolio policy, not the other sections of the CIS policy that you might have read when you were going through all the board materials and seeing the different markups. So that's where we're focusing our attention again today. Next slide, please. In January, I think we felt that there was broad support for many of the recommendations regarding the CIS private portfolio. So this second reading presents what we believe are refinements rather than sort of wholesale changes. Firstly, and I sort of call them out here in this like the green text that you can see here, the policy now references innovative strategies in addition to real estate, private equity, and inflation sensitive. As you know, the Innovative Strategies team, which is led by Geraldine Jimenez, also currently invests in private market assets, and particularly in opportunities that might not fit neatly into other asset class strategies, or that might require a period of incubation. And as similar opportunities are likely to exist for the CIS portfolio, we believe that it makes sense to also reference the Innovative Strategies policy in order to have a consistent approach across both innovative strategies and CIS to these types of private investments. So that was the logic behind that introduction as well. Secondly, we wanted to provide clarity on the underlying benchmarks for the portfolio. So in the policy, you will have seen that we've added an additional table that lists these out just for ease of read and clarity for everybody. And thirdly, as the CIS policy, and we've sort of been really emphasizing this, I think, all along, relies on the parameters set by the underlying 4 asset class policies, we felt that having a sort of a breakout of our own additional geographic policies is actually now redundant. So those are the 3 kind of big policy shifts that you'll have hopefully seen and read in the materials. If I could go to the next slide, I'll just take a little moment to explain how we expect the CIS policy to work in practice, and specifically how the proposed inclusion of innovative strategies impacts the governance of the portfolio. In January, we explained that there are 2 subcomponents to the CIS policy in the portfolio, which internally now we're sort of shorthand referring to as the scaling component, and then the new opportunities component, as this diagram lays out. And you'll remember back in January that Julie Donegan from real estate and Margot Worth from private equity joined me to explain how we intend to collaborate on the scaling investment opportunities, and specifically around affordable housing and in low carbon solutions, respectively. Since that discussion and our meeting, we've spent a lot more time amongst the teams, making sure that we're all aligned on the governance of the CIS private portfolio. And while there's a lot of more detail, more discussion and information that sort of underpins this summary, I think it's easiest to think of it this way. For scaling opportunities in the portfolio, they rely on the governance models of the underlying asset classes in order to approve investments. For the new opportunities component, they will rely on the governance model that we currently use to improve investments in the innovative strategies portfolio. And we believe that this is a robust model that relies on our existing processes. So it really helps us all be clear on roles and specifically where decisions are being made and where oversight lies. If we go to the next slide, I'll just spend a couple of minutes digging deeper into the implementation of the policy and our hopes for it. Nothing has changed since January in our pacing plan for the real estate and private equity components that we discussed and shared with you. But Geraldine and I believe that it's also appropriate to target between $250 to $500 million annually of committed capital in the new opportunities component of the CIS portfolio, which we believe will be predominantly in low carbon solutions. And as you know, this aligns very much with our low carbon transition work plan. Specifically, these kind of investments might be in a new fund with an existing CalSTRS partner that we believe is additive to the total fund, but where they might not fit easily within an existing asset classes benchmark or strategy. Or they might be investment opportunities that may exist with new CalSTRS partners. So again, I just wanted to clarify how this is going to work in practice. And again, these sort of two sides that fit to the portfolio. I hope that explains the sort of the enhancements that we're proposing in this second read. The other follow-up area, if we could turn to the next slide, that you requested in January was for Makita to provide their suggestions for overseeing and their reporting on the CIS portfolio as it evolves. You'll have hopefully seen Makita's memo in your board materials. It identifies 4 primary recommendations. They're also summarized here. This approach references a model that you're familiar with, I believe, already, that currently exists with Stephen Tong and the RMS team. And you're going to be hearing from them, obviously, later shortly as well. Now, Steve McCourt is obviously in the meeting today with us, and he's ready to answer your questions on their recommendations that I've sort of highlighted here. So my final slide, it's just to say, to sum up, today we're seeking your approval for the CIS private portfolio policy second reading. I've laid out some next steps, which we talked about last time, but I think, today to focus on obviously your thoughts on this. I'm eager to hear your questions. I know Steve is ready as well, and some other members of my team. So look forward to your questions and our discussion. Thank you.
Thank you very much, Kirsty. And thank you for working with, with Stephen and with Tiffany and others to address some of the questions that came up, I think, during our January meeting. But while I'm waiting for any board members to, to let us know if they have questions, maybe Steve McCourt, if you could come online, maybe I'll just ask you to make a comment about the monitoring that we suggest putting in place for this program, and anything else you'd like the committee to be aware of in terms of how we would work with Makita to get that up and running.
Great, thanks, Joy. In our memo we provided, and in Kirsty's presentation, she went over the areas that we discussed with Fiduciary Council, which, as Kirsty said, are largely based on an existing model we have for enhanced monitoring and oversight of the RMS asset class. So that involves more frequent and formal engagement by Makita with CIS staff directly, CIS staff completing information requests regularly, Makita providing to the investment committee a scorecard and a rating system for the execution of the CIS portfolio, and reporting to the committee specifically on the CIS portfolio on a semi-annual basis. So all of that is more or less borrowed verbatim from the model that we've used in the RMS asset class for the last 5 years ago, and seems to work, at least from our perspective, fairly well. The one other thing I want to be transparent on as well is the enhanced monitoring does come with a modest added cost associated with it, as does our work on the RMS portfolio as well. So once the committee decides if it wants to have an enhanced level of oversight on this portfolio, we're happy to provide our estimate of the fees associated with providing that enhanced monitoring.
Great, thank you, Steve. So I do have some board members that have questions. I think first up we have Gail, and then we'll go to Jennifer. Gail?
Thank you, Madam Chair. And thank you, Kirsty. That was a great presentation. I do think some of the questions that Steve raised in the memo about sort of these benchmarks, and you'll recall that I always have these questions about benchmarks because they, on the one hand, they're bogeys, and on the other hand, they tend to sort of complicate, I think, sometimes where we want to go, and we use them interchangeably for different purposes. So I in some ways, I think this is ripe for a larger conversation. But in some ways, and I understand how not everyone wants to be accountable for the CIS portfolio, and this was kind of an internal negotiation. But I just want to make sure that because of how much complexity we're adding to this, it's not actually going to kind of slow down the decision making and our ultimate objective, which is to ensure that we do have kind of more robust opportunities and investments in this area. So if you could speak to that, and then just talk about how it actually could, instead of being more complex, would actually be more dynamic. I still can't see how that can be operationalized.
Sure, happy to respond to that, Gail. Thank you. I think what we've tried to do in this, although clearly, given that we're going to be looking at opportunities across different asset classes, that in itself leads to a level of complexity. I think in trying to ensure that we're following what already exists. That is where I think, we're not introducing a new level and layer of complexity in terms of how the governance process works, in terms of how we hope to have, a robust approach to how we think about pipelines, identifying opportunities, due diligence, and sign off. That is something that we want to be consistent, and that we will be modeling what already exists in the other asset classes. So I actually think in that respect, it allows us to be nimble, and it allows us to be thoughtful at the same time. So that's what we've really tried to do on that side of things. I think in terms of what you were mentioning on the benchmarks and how we roll those up, again, trying to ensure that we default to the underlying benchmarks is the key. But yes, we recognize there is some additional work that will be done to both provide the underlying asset classes where there might be some monitoring in terms of our investments in the CIS portfolio contributing to their allocation, and also from our compliance and performance monitoring teams for allowing the CIS team to see how our portfolio is doing as a standalone. That's going to be incredibly important because ultimately we want to show that this is additive to the total fund. So there are those levels of complexity, but I think as we mentioned last time with Shafat and her team, we're confident that we have that all under hand. And I'm certainly confident that the partnerships that we have, the way we've structured it with the asset classes, allows us to do both. I don't know if Scott or Chris wants to add anything to that from your perspective, because I know I'm speaking from one angle.
I would love, just as we go through this, and obviously we're really supportive and think it's an exciting opportunity, but just to do a little check-in on this, because I still think that it seems as though we're sort of adding the benchmarks to protect the other asset classes, which I understand, but just want to make sure that we're not overcorrecting for that. And I'm a little bit concerned that we should be cognizant of that. So just to follow up on Steve's point, it would be nice, I think, just to make sure we're kind of having this review of this portfolio, especially on this piece, because rather than making it kind of in toto part of everything, I think you're segregating it in a way that could be totally successful, but I definitely think you may want to be open to a midterm correction on how these benchmarks are working so that you're not so caught up internally with making sure all asset classes stay whole and really are focused on the overall objective of the CIS portfolio. So certainly not a today thing, but in the future would be good to review that.
Great, thank you.
Gail. Next we have Jennifer, and then after Jennifer, we'll go to Bill and Harry. So Jennifer.
Thank you. And thank you. I'll add my thanks as well for a terrific presentation, for all the work you're doing. I feel that the policy as proposed is very thoughtful. I would add as well a request that as we do get the reviews, we understand how it's working. But in terms of going in, I think it's extremely thoughtful, and I really appreciate that. In addition, just one question, and my apologies if this is just a new board member. So a short answer is great, but with regard to the benchmark for the innovative strategies, because that's customized, could we just get a very short description of how those individual benchmarks will be set? I recognize that that's a small portion of what might end up here, but just so we understand the process.
Absolutely. And this is, again, from the innovative portfolio side. And I don't know if Geraldine Jimenez wants to come and also contribute here. So I'm not talking totally on her behalf, but not to put her on the spot. It's basically an opportunity that they have to benchmark to a T-bills in the short term. But then as the portfolio matures, depending on the underlying asset class that it most closely tracks, it then defaults after Makita has reviewed it to that underlying benchmark. So this allows for sort of like a maturation or an evolution of the investments within that portfolio. And we would be following that structure as well.
Sure. And just to add on that, so our standing practice for public assets, they follow a public market benchmark. Because of private assets, the J curve takes a while for the investment to actually return after you've committed capital. We allow for 3 years with ongoing oversight of Makita, but at 3 years, there's a hard, firm review of each investment opportunity. Is it time to move it to more of an industry benchmark? And what is it due to the J curve already being passed? So it's really set up to look for success, but not look for success in year 1 or 2. It's an acknowledgement that takes time to put capital out to actually get the return in a private asset.
Terrific, thank you. And so Geraldine and Kirsty, as at the initial underwriting, you'll be giving some thought to where you would anticipate the best fit, and Makita the same, and with a high probability that it'll cut it, if you will, for the ultimate benchmark, giving effect to the startup period.
Yes.
Is that correct?
Yeah.
Okay. Thanks
Yeah.
so much.
Thank you. Thank you,
again.
Geraldine.
Thank you, Jennifer. Bill.
Thank you, and I'll add my congratulations on a great report, Kirsty. And I have a question for Stephen. One of the oversight items you have is you will develop a scorecard for the investment committee. Tell me what you envision the elements of that scorecard to be, if you can today.
Yeah, and a little bit off the cuff here, Bill, and aligning it with how we approach the RMS scorecard. There would certainly be an element of performance review associated with a scorecard, an element of staffing, an element of mitigating conflicts of interest, an element of ensuring that fees are kept to a minimum, and an element of alignment of the execution of the strategy with the policies and investment beliefs of CalSTRS. So I would imagine there might be 5 or 6 different segments that we regularly evaluate and score. And there might be more, though. Those are just kind of off the cuff thoughts.
Would you also be looking at the appropriateness of the benchmarks?
Yeah, we would look at that regularly, as we do with all of the policies as well, for sure.
Okay, thanks.
Bill, we'll turn it over to Harry.
Thanks, Joy. Fully supportive of the policy changes and cautiously optimistic about the endeavor and opportunities that are ahead. Fully supportive of Makita's independent oversight for the committee, and appreciate Bill's inquiry about some of the specifics in terms of the scorecard and that they'll provide. But I think it's very prudent for us to have that independent set of eyes reporting back to us and giving us visibility. I would like to put out there for the board and the committee to think about, if my memory strikes me correctly, for years we've heard about the complexity of the benchmarks that we have. one. And two would be the number of benchmarks that we have. And I see a couple of nodding heads on the screen, which leads me to think that my memory serves me correctly. So as I read more about benchmarks, and we're adding new benchmarks, and I'm not an expert on benchmarks, I do believe that the committee has some new people on our board who have some expertise and some talent and some experience dealing with benchmarks. So I would like to suggest that as we start to look forward to the 21-22 year, that either a small working group be formed and or as part of the compensation committee. And I would, we don't have to make that decision today. I think we can get guidance from our governance consultant on what would be the best format. But I would suggest that two issues that I think would be worthy of pursuing. One is the number of benchmarks that we have. And secondly, the complexity. So put together a small working group that works with the appropriate consultants and staff as appropriate to address that issue head on, complexity and the number of benchmarks, and tap into the expertise that we have on this board, either in a small working group or through the compensation committee with potentially a new chair of that committee for the 21-22 year. So I wanted to put that out there for the record today, that I think it's worthy of pursuit. And I know it's not directly linked to this item, but since benchmarks are, I thought it was a good opportunity to raise the issue.
Thank you very much, Harry. And I just want to say I'm fully supportive as well. I mean, I think one of the really neat features of this, of the policy changes we're being asked to consider now are the way in which it's going to, I think, encourage even more collaboration across asset classes, and want to have team members work together. And so making sure that as we're doing that, we also address any real, perceived, or other other issues that might make it challenging in order for people to work as collaboratively as possible. I think it will be important to do. So thank you for your comments. I know that I just want to ask Scott Chan, given some of the sort of budget and appropriations issues, Scott, were there some comments you wanted to make about that?
Yeah, thank you, Joy. I just wanted to make sure the board understands that we have sort of two budget processes, and the CIS team is continuously appropriated versus the rest of the investment division. And so every transaction, for example, has costs in it, right? I mean, it used to be that we were traveling, there were travel costs. There's certainly cost to value assets. I mean, for example, if we were to be investing in battery storage, we would send a team out there, we'd hire a team to value some of those specific assets in the field as part of our process. These are typical transaction costs that would go into any transaction. So I don't foresee an increase in transaction costs, but I want you to understand that one budget might be sort of going down, if you will, and one budget might be going up. And the board, as you know, votes on the continuously appropriated budget, which CIS is in. So there might be some future follow-up where we discuss that element of it. Hopefully I described that accurately. I don't know if there are questions around that.
I don't see any questions, Scott. Okay, thank you.
Thank you.
Okay, well, this policy is in its second reading. It is an action item. I would offer if there are any board members who'd like to make a motion. Hang on. Before we do that, maybe let me turn it over to the controller. Betty, you had a question?
Thank you, Joy. No, I'm happy to move approval of the policy.
I'll second it.
Great. Okay, so it was moved by the controller and seconded by Bill. Let's see, Scott, are you on? Do we need to do a roll call vote?
We can do that, absolutely.
Okay.
Ms. Bradford?
Yes.
Ms. Hendricks,
Yes.
Mr. Keeley,
Yes.
Mr. Bazant,
Yes.
Ms. Erden,
Yes.
Ms. Yamamoto,
Aye.
for the Director of Finance, Ms. Miller,
Yes. Yay.
for the State Treasurer, Mr. Saha,
Aye.
for the Superintendent of Public Instruction, Mr. Yamanaka, I didn't catch that. For the Superintendent of Public Instruction, Mr. Yamanaka. Very good. Controller Yi.
Aye.
Chairperson Higa, do you wish to vote?
Yes, I vote aye.
Very good. The motion passes.
Okay, wonderful. All right, thank you very much. Thank you, Kirsty, and Chris and Scott and Stephen. Thank you very much also for the work working with Nikita. Appreciate it. Thank you, everyone. Okay, Samantha, are there any public comments on this particular agenda item number 4?
There are no public commenters for item 4.
Okay, thank you. Now we'll move to agenda item number 5, which is the first reading of our RMS policy revision. Also just kind of reminding the committee we have 30 minutes allotted for this item, so I'd just appreciate it if the committee and staff and others would keep that in mind. I think Stephen Tong and Carrie Lowe are joining us. Hi, I see you. Good to see you, Stephen and Carrie. Chris, are there any opening remarks you want to make, or are you going straight to Stephen? Okay, Stephen, we'll turn it to you and Carrie.
Good morning, Madam Chair, and thank you for its time, and good morning, committee members. My name is Stephen Tong. I'm your Director of Risk Mitigating Strategies. And for today's presentation, Carrie Lowe, who is a portfolio manager overseeing the trend following and the systematic risk prevent, is also joining me in this presentation. So the purpose of this presentation is really the first reading of proposed policy changes for the RMS portfolio. And the proposed changes that we're making really falls into 2 categories. First category is the strategy allocation. And the reason why this is really an important area, and it really speaks to the expectations for the RMS portfolio, its purpose and its role, but also the total return. Secondly, we'll be addressing benchmarks. And there's 3 items that we want to kind of talk about today. First, in the benchmark area is really the benchmark for one of the components, which is the global macro. We'll spend the next area that we want to touch on briefly is the benchmark for the total RMS portfolio. And then lastly, just touch briefly on some challenges with the current benchmarks in place. Can we move to the first slide, please? So what I want to begin with is this first slide here, and this is a depiction of the current allocation in the RMS portfolio. So briefly, the largest component is the trend following, and it's 45%. We have US Treasury at 40%. And then the next component is global macro at 10%, and then systematic risk premium is 5%. Currently, the portfolio is, as of, I believe, December 31st, it's roughly about 25 billion. And the actual allocation with respects to each of the strategy is close to its strategic weight, with the exception of the systematic risk premium, and we're currently under the 5%, roughly about 3% of the total RMS program. And the total RMS portfolio currently right now is about 8.6% of total fund. Can we go to the next slide, please? So this first slide here, we want to just talk about the strategic asset allocation. Back in late 2019, we decided among the RMS staff that we needed to review the allocation among the strategies. And so what we decided to do was to help us along with the study. We also asked Cambridge, who was our interim advisor, as well as Elixir, to help us to conduct, also join in the study, but for them to, we asked them to do independent analysis. We wanted to determine whether or not we had the optimal portfolio to achieve the desired goals. Again, that's long total return, as well as providing the diversification when it matters, and specifically to provide diversification when there's a drawdown in equities. So as we progressed through the study and we compared our conclusions, our findings, to a similar conclusion, and that is to, it was necessary to increase global macro slightly, and the offset to decrease the US Treasuries. We presented our findings to the CIO as well as the DCIO, and we also asked Nikita to review our findings. So all the parties I just mentioned to concur with our recommendation, and that is to increase global macro from 10% to 15% and decrease US Treasuries from 40% to 35%. Just a couple of reasons might help give some basis for the reasons for our recommendation. First of all, US Treasury still is an important component of the RMS program. As described in the committee materials, it is a first responder, and it complements the other strategies in the portfolio. As we look forward to the macroeconomic environment going forward, however, what we found is that, and this is based on past history, where we're in periods of rising interest rates, global macro tends to be the best performer of all for existing strategies. And so hence, this is a reason why we're recommending a slight adjustment, increasing global macro again by 5% and decreasing US Treasuries by 5%. Can we go to the next slide, please? On this slide here, what I want to, can you go to the next slide, please? Thank you. On this slide here, what I wanted to talk about is sort of benchmarks. And so on this pie chart here, what you'll see that's different from the first chart is that you'll see that global macro is divided into two sub-strategies. We have the discretionary component as well as the systematic component. Again, just as a reminder, the strategy itself is, it uses fundamental macroeconomic data to derive its investment decisions. And from the discretionary macro, the manager uses judgments based on those macroeconomic data to make investment decisions. Whereas in the systematic space, what the manager does is that they develop models and algorithms to make the decisions. So as you can see, just based on the management styles, the return to sell patterns tend to be slightly different from each other. Currently, right now, we have 4 managers. 2 are in the discretionary macro and 2 are in the systematic macro space. And currently, the portfolio, as it stands right now, is roughly a 65-35 split. As we continue to add managers, it's our intent at this time to add to the discretionary space. So right now for the macro, the benchmark is a single benchmark, and it is a discretionary benchmark. What we did was when we asked Nikita to actually look at this, the benchmarks, one of the things that they suggested, and we agreed to, is to their recommendation, is that really there should be 2 benchmarks, one for the discretionary macro and one for a systematic macro. And so in the policy, in the policies, you'll see the benchmarks that we're recommending. So can we go on, or you can stay on this, I'm sorry, go back to the previous slide, while we stay on this slide. So now I just kind of want to move on to the next item with respect to the benchmark. And this is the way the benchmark is for the total RMS portfolio. And the methodology that's being used is what's called dynamic weighting. And that is the current methodology used to calculate the total portfolio benchmark for RMS. And the policy itself, when it was originally constructed, it was intended that once the RMS portfolio reaches its full construction, and that each of the strategies reaches its target weights, that we would switch over to what's called a strategic weighting. The recommendation, though, is that we, instead of moving to that strategic weighting, we want to continue and make it dynamic weighted, and that would be the benchmark going forward from this point. And there's a couple of reasons why we're making this recommendation. First is that by having a dynamic weighted benchmark, it really allows the RMS team to really focus in on the construction of each of the strategies. We really want to make sure that the program itself is it's performing its purpose, and that is providing the diversification when it really matters. And the second reason is that this really helps us in terms of minimizing the costs that will result, or minimizing the costly rebalance that will result if we were strategically weighted benchmark instead of dynamic. So I'll turn it over now to Carrie, and she'll talk more about the ranges around each of the individual strategies. So Carrie, would you like to take over?
Yes, thanks. Please move forward 2 times in the presentation. Thanks. Along with the benchmark changes proposed by Makita and with which we concur, we believe a smaller range around the strategic weights would be sufficient. Rather than the current plus or minus 10% range, we have modified it to plus or minus 5%. Next slide, please. And with these changes, we believe we have the best benchmark available under current circumstances, but also wanted to add to the conversation on benchmark challenges. Some of these are unique to RMS and make it difficult to outperform on a relative basis, while also trying to achieve a certain level of absolute return and perform during equity downturns. These include that the indices are not investable. We can't replicate the index because it's not possible or practical to own all of the index constituents. The indices may not be beta neutral. They may benefit from a strong equity market, while the RMS portfolio is meant to have a low beta and generate returns more independent of equity markets. In addition, the index constituents are equally weighted. In the RMS portfolio, we don't assign the same weight to each manager. We consider their volatility, the outlook for each manager, and other factors to determine the appropriate weights. And lastly, the indices can be made up of very different sub-strategies. We try to account for this in macro by including both systematic and discretionary benchmarks. But for systematic risk premia, our portfolio deliberately excludes some risk premia that are in the benchmark, as well as includes some risk premia that are not in the benchmark. And that's the end of our presentation. We'd be happy to take questions.
Great, thank you very much. Thanks, Stephen, and thanks, Carrie. We do have some board members with questions. I'll start with Sharon.
Thanks, Joy, and thanks, Carrie and Stephen, for the presentation. I guess it all connects back to the last presentation and the benchmark conversation. I just, I was reading on I can't see what page number it is, but 75, I think, where it talks about modifying global macro benchmarks, and the recommendation is moving it from solely discretionary to systematic and discretionary, which seems more complex. And we just, we're talking about, trying to make things less complex. And so I guess I'm sort of highlighting that I don't have a problem with the recommendations. I guess I just maybe it's just highlighting some of the challenges we have moving forward to, obviously we want to do what's right for this particular asset class and give staff the tools that they need. But I guess I'm just sort of highlighting, we just had a conversation about reducing complexity. And so I certainly want to do whatever's the right thing, but I also just think keeping those things in mind, it just underscores our need to do some work on benchmarking, I think, moving forward. So appreciate the presentation though, and I support, the staff's recommendation. And I didn't know if Stephen from Makita had any thoughts about that. Obviously you concur, but the complexity that kind of stands out to me.
Yeah, and I'll bring Mika on here as well because she's worked closely on the benchmarking issue. But just to comment more broadly, and maybe to front run a subcommittee to focus on benchmarks, there's always going to be a sort of tension between precision and benchmarking to capture the information you want to capture in the most precise way versus the complexity and the challenges of dealing with complexity. And I think this is a good example of that in an asset class that really isn't a traditional asset class. It's more of a functional asset class with a purpose to mitigate risk. And so that makes it also a really interesting and challenging asset class to benchmark as a policy body. But let me hand it over to Mika to talk about some more of the specifics.
Thanks, Steve, and thanks for the question. One comment that I wanted to make regarding this kind of trade-off between complexity and then creating a benchmark that most accurately represents the opportunity set is that in an area like RMS, we're always going to be faced with that kind of push and pull. And so this addition of, including both systematic and discretionary as one example, Sharon, to your point, is, we want to both accurately roll up RMS performance into the total fund so that when we're looking at how your total program is doing, we can accurately assess that. We also want to acknowledge that at CalSTRS and at many other programs, the benchmarks that are utilized for each underlying strategy, in this case RMS, are also utilized for incentive compensation for employees. And so for those reasons as well, sometimes additional complexity is necessary to be able to provide a more reliable platform, I think, from which to assess performance of the strategy. That being said, I completely agree that the more time we can all spend thinking about how to do this in a less complex way, the less headaches we'll all have going forward. One thing that I wanted to note for the investment committee's consideration, and one thing that Makita has been thinking about is, with respect to RMS specifically, as Steve mentioned, this is really a portfolio designed to reduce the risk that you are exposed to in the equity markets. By nature, while there are ways to assess risk, you can look at downside capture relative to equity markets. A lot of these things you see in our quarterly memos regarding the RMS portfolio, but they're not used to formally assess the returns of the program at a benchmarking level. However, I think that it makes sense to consider whether the incentive compensation structure for RMS, given those examples, might need to be reassessed to consider more qualitative components where we could utilize success factors related to the risk profile of the portfolio in order to ensure that we are both incentivizing staff to do the right things, in this case, to keep the risk profile of that program in line with the objectives of the policy, and also to just fairly assess how well they're able to execute on that. So just wanted to note that for the group as well. It's something that we are looking at and hope to continue to discuss in the future.
Thanks, Mika. That was actually, that really helped kind of solidify my thinking, and I think where we're headed moving forward, both with comp and with this conversation. So thank you for those comments.
Sure. Thank you, Sharon. So I have a few other board members. We'll go to Jennifer next, and then to Controller Yee. Jennifer?
Thank you, Joy, and thank you for the terrific presentation as well. My comments are very much along the lines of, along the lines that Sharon mentioned, but I would just ask if we really look at what is the purpose of this allocation and what are we trying to measure, and put that in the context of the very real both opportunities and challenges of executing in these strategies at size, and the considerations of these benchmarks that have been proposed. I would really encourage us, just following the line of this conversation, to be mindful of how we might best align that in a imperfect situation, if you will. From my perspective, the team has been delivering on the protection that we need when we've needed it. And yet we have this situation, with what we can invest in as well as these benchmarks. So I would just ask sort of two things right now. One is, as long as we have the commitment to continue to look at this inherently challenged situation, but with benchmarking, and additionally then with bands that have been tightened, does that give the team the flexibility you need, to execute at scale and the best opportunities for CalSTRS?
Maybe I'll jump in.
Stephen.
It looks like Stephen. I wanted Stephen to address whether the staff feels comfortable with the tightened bands. But from Makita's perspective and continuing to evaluate the benchmarks, I think, Jennifer, the great focus needs to be on the benchmark related to the investments and looking at that as really going to be a returns-based analysis that rolls into the total fund, and then separating that a bit from what flows into kind of an incentive compensation evaluation structure as well. So I think that continued conversation needs to happen on both fronts.
Okay.
Stephen, can you please address your bands and how you tend to manage within them?
Sure. So briefly, we touched on reducing the bands. Currently, right now, it's set plus or minus 10% around the strategic weight. And we want to reduce that to plus or minus 5%. And the reason, sort of the thought behind that is it goes to a question of what is the purpose and the role of the RMS portfolio. And we want to make sure the design of it along the strategic weighting, we think it's represents sort of the optimal portfolio as it stands today with the opportunity set that we have dealing with. So it's important that we tighten the ranges so that we don't drift away from these strategic weights. And so what we're trying to do is really balance sort of the overall goal of the program, but also be mindful because of the uniqueness of each of the strategies. We don't want to be in a mode where we constantly need to rebalance the strategies, which would run up the cost of the program and detract from returns. So based on our work, we felt like tightening it up from plus or minus 10 to plus or minus 5 is appropriate.
Okay, thank you.
Betty?
Thank you, Joy. I just had a question with regard to manager selection, which has been a challenge with respect to the global macro managers, and just want to get your sense of level of confidence, I guess, as we're looking to scale up, about the ability to just find the right managers to scale up these strategies.
Thank you, Betty, for that question. It's a very good question. So as you were, the process, the way it works right now is that we have an advisor to help us with manager selection. And currently we're onboarding Alborn, who will be our permanent advisor going forward for the program. So the role is that the manager or the advisor would help us search and find managers for each of the respective strategies. And we would do the due diligence. And in order for a manager to be approved for the program, both staff as well as the advisor would essentially have to agree after the due diligence. So within the global macro space specifically, it's a space that that the best managers charge the highest fees. And so we're very mindful of this. And so we're trying to balance out finding managers that think that would best serve the program, but also being mindful of not paying fees that are beyond sort of this 2 and 20 level. So happy to report, though, that based on the work that Cambridge has done for us on helping with manager searches, we identify 2 managers that we're currently in process of negotiations right now and trying to finalize the contracts. It is our at this current where we are today, we probably will be able to onboard by the end of this fiscal year. And so that will help us address sort of the capacity issues that we face with the global macro, and also help us as we move forward in moving the RMS portfolio towards 10%.
That's great. Thank you. That's great news. I guess maybe slightly related to that, I know Makita flagged the future discussions we're going to be having about implementing a risk budget for RMS, and just wanted to get a sense of whether, well, first, when that's expected to happen, and would that have any impact on your evaluation of managers?
Scott, do you want to address?
Did you want me to grab that, Stephen?
Yeah, please. Thank you.
Yeah, so I think the benchmark discussion, the robust benchmark discussion we've had on the RMS portfolio has been illuminating, because there's a very large tracking error between the benchmark and the performance of our portfolio, because there are a lot of differences from the amount of leverage to the investable universe. We have obviously a smaller subset of that portfolio, and we can't invest in the benchmark. So there's a number of sort of benchmark and tracking error issues here, which create a larger amount of difference. All that being said, we think that the risk budget approach is going to be very much applicable to our public market assets, so public equity, fixed income. And I think on the alternative side, the debate isn't as if we could actually utilize them on an operational basis because of the sort of the difficulty to match a benchmark. But maybe the thought or debate internally is whether we can use a total fund approach in a longer term schematic and thinking about risk and return for the alternative assets. So our plan, I just wanted to build up to that explanation that we don't plan to necessarily propose a risk budget either in RMS or any of the alternative assets where the benchmark is difficult to match with the performance, because operationally it just becomes difficult to utilize that day to day. We might think about it, though, on a total fund basis on a longer term trajectory. But for now, for sure, we're proposing them for the public markets assets. And so you'll see that coming up with fixed income and CIS will be the next 2 to propose risk budgets.
Right. Okay. That's helpful. Thank you, Scott. Thank you. Thank you, Joy.
Okay. I don't have any other board members in the queue. Just as a reminder, this was the first reading of some policy changes for RMS. So unless there are any other, comments or questions by committee members, this will come back for second reading in May. Okay, very good. All right, Stephen and Carrie, thank you very much. Really appreciate it. Mika, thank you for your comments and your work on this project as well. And we look forward to taking this up at our next meeting. Thank you. And I realized I didn't ask. Samantha, are there any public comments related to the specific agenda item number 5?
There are no commenters in the queue right now.
Okay, thank you. Okay, so now we're turning to 3 items 6A, B, and C, which are our opportunity for review of our semi-annual performance reports, being able to have a conversation with our consultants. We'll start with our general consultant and then move to real estate and private equity. I know that that the committee members have had the opportunity to do this previously, but just want to remind everyone that this is part of our fiduciary duty, part of our due diligence that we do over the course of the year. And while we are always able to reach out to our consultants and ask questions, this is a good opportunity to make sure that we hear from them about any risks, concerns, opportunities that they see for us in our portfolios, and we have a chance for an open conversation with them. We're doing this both in open session right now, and then when we moved into closed session, we'll have an opportunity to address any specific managers or investments that are more appropriately held in closed session. And just in terms of a sort of a time check, we have for the first portion related to our general consultant with Stephen McCourt and Makita, we've got 20 minutes, and then we'll move into real estate and private equity for 15 minutes each. Okay, Stephen, I think I'm turning it directly over to you. Welcome, and look forward to the discussion.
Great, thanks so much. I took the opportunity to jot down some prepared remarks on the semi-annual report, and I might take about 5 minutes going through these remarks, and then happy to take questions afterwards. So let me start with a few observations on 2020, and then move into the review of the CalSTRS performance for the period. As we reflect back on the capital markets in 2020, we find ourselves somewhat strangely remarking more on the fiscal and monetary reactions to the COVID pandemic than the actual economic impact of the pandemic itself. It was the policy actions that really drove much of the market's behavior in 2020, and arguably so far in 2021 as well. The COVID-19 pandemic that hit the global economy in February 2020 set the stage for unprecedented monetary and fiscal stimulus in the US and abroad. This stimulus impacted the capital markets meaningfully. Interest rates across all maturities fell remarkably as the Fed communicated that short-term interest rates would remain extraordinarily low for a prolonged period of time. 10-year Treasury bond yields finished 2020 a bit under 1%, 0.9%. That was a full percentage point lower than 1 year earlier. Historically low interest rates conspired with massive fiscal stimulus to cause equity markets to stage a historic recovery after March. Somehow US equity markets finished 2020 with a return of 21%, a truly remarkable achievement given that the US market had lost 30% of its value between late February and late March, which was the most rapid decline of the market since the Great Depression. US equity markets generally outpaced foreign markets in 2020, and as we'll note, growth stocks significantly outperformed value stocks. For 2020, the US equity market returned 21%, while global equity markets returned 11%. Much of that return differential was attributed to the higher concentration of technology and growth stocks in the US. Most of the global technology companies reside here, which helped our markets. Within the US, growth stocks returned 39% for the year, and value stocks returned only 3%. So it was truly a technology and growth-driven rally in the markets. Moving on to the CalSTRS portfolio, as of December 31, 2020, the total CalSTRS portfolio was valued at $283.4 billion, an increase of $29.3 billion from 1 year earlier, despite a global pandemic, the largest economic contraction since the Great Depression, and significant operational disruptions to the way that CalSTRS and all their institutional investors invest. CalSTRS returned 13% for the calendar year of 2020. That's nearly double CalSTRS' long-term expected rate of return, 60 basis points in excess of CalSTRS' policy benchmark, and 110 basis points in excess of median large public plans. Over the last decade, CalSTRS outperformed the median large public pension plan by 80 basis points per year. Our rough back of the envelope calculation is that level of peer outperformance equates to about $20 billion of added value to the plan. To state the least, this overall is a very positive report. Digging into some of the asset classes, strong private market relative results reflected solid implementation within the inflation-sensitive private equity and real estate asset classes. We'll leave it up to your asset class specialist consultants to report on the specific drivers within those asset classes. Fixed income produced particularly strong relative returns in 2020, outperforming its benchmark by 90 basis points, driven by both strong external active management and internal portfolio management. Global equity underperformed its benchmark slightly for the year, largely due to the challenges of an equity market increasingly driven by a few large US-based technology companies. Value-oriented and quantitative active strategies struggled during the year. The only major asset class with notable underperformance in relation to its benchmark was the risk mitigation asset class. And that underperformance was largely driven by weak active management performance across the global macro and systemic risk premia components. While staff is addressing this underperformance appropriately, we do note that the RMS asset class performed its role very well during the year, posting a strong positive return in the first quarter when global equity markets were down 20%. As we just discussed, benchmarking in the RMS asset class is, by its nature, quite complex. In conclusion, CalSTRS navigated a remarkably uncertain economic and capital market environment very well in 2020. Staff's execution of the investment policy is particularly noteworthy given the obvious challenges of executing in a fully remote environment. We applaud staff for their ability to adapt and execute in 2020. With that, I'll turn it back over to the committee for any questions.
Wonderful. Thank you very much, Stephen. Let's see. So while any committee members are getting into queue, I was taking a few notes while you were talking, and just one statistic I wanted to make sure I heard correctly was that looking over I don't know what the specific time period is, but CalSTRS has outperformed its sort of median plans by about 80 basis points. Over what time period was that? And I think you also referenced that roughly equated to about $20 billion in value.
That's over the last decade, so the last 10 years. And that's a rough calculation based on the starting market value of CalSTRS.
Great, thank you. So I think it's always important to sort of reflect when we have a chance to do these portfolio reviews. Both look at what's happened in the most recent period, but also look over the long term. And what a superb job our team continues to do. So we do have a couple of board members who have questions. I'll go to Gail and then Bill and Jennifer. So Gail.
Thank you, Madam Chair and Steve, and to the whole investment team. This past year was really kind of a spectacular year. I think you executed really well, and lots of cause to really pat you on the back and congratulate you for a job really well done. So with that, though, I think there are kind of extraordinary challenges in the future. So I do think, because I don't know how reliable kind of this past year will be, just given these incredibly high valuations and low interest rates, and your ability to kind of manage within that, and then obviously some of the crazy behaviors we see in the market. Just sort of, I'm interested to know, as we look forward, not only a review of how well you did, and I think, again, lots of kudos, but just ideas of how you're going to face the challenges, everything from kind of staff, how you make sure that folks stay, and just a keen awareness for what can go wrong. I think, people remain a little bit shocked about this market. And I think as we sort of just a recognition of some of those challenges and how we can really build on our success and our increased liquidity and our ability to move in a more nimble, faster way, kind of how you see our ability to really address those challenges. But happy to wait if you want to get other folks' questions first and then answer together. I don't know, Madam Chair, how you want to do that.
Fine. Chris, would you be comfortable responding to Gail's question?
Sure. Gail, we're going to succeed and win and do it just like we have in the past. Not to make light of it. Yeah, we're struggling trying to figure out, like everybody else is, how do we get back to the building? How many people work remote? How many people work in the building? How do you handle hybrid, where people we're great 100% virtual, and we did 100% in the building well. How do we do both? And then certainly the struggle with low interest rates, although today the stock market is worried about high interest rates and the bond market is backing up. And we'll talk a little bit more about that in the rack. So definitely a challenging future. It always feels challenging. I have to say right now, it feels even more challenging because we just don't understand the future and we have no past experience with a hybrid work environment. So we're just putting all of our brains at it. We're tapping into certainly other ideas. We all are circulating a lot of McKinsey, a lot of Korn Ferry articles on hybrid work environment. Our TAC, we just spent over an hour and a half yesterday talking about interest rates and what we thought the future might hold. Our new economist, Benjamin, who's on Geraldine's staff, ran through a bunch of different scenarios around the whole globe. So Asia, including China, Europe, and then North America, not just the US, but Canada and Mexico, and how we looked at the chance for GDP growth, which looks like it will be low around the world. And then the fact that the balance sheets of all the central banks are so huge. So challenging environment going forward. Now, that said, we have had spectacular returns so far this fiscal year, knock on wood. We still have 5 months to go or 4 months to go now. Interest rates being so low, people are financing and it's still risk on. We know that will ebb and flow and we could stay in this kind of a strong market and a equilibrium. But I wonder, once we really do see vaccinations increase, nobody knows if we'll hit herd immunity. We also don't know how quickly everybody wants to return to normal. And it sounds crazy, but whether that's actually a really good thing. We know it's better to be back in person and working, but that transition from where we are now to there, the shutdown happened so fast in a matter of days and the market reacted in a matter of days. Now this transition back will take longer. So long-winded answer just to say the future is going to be very challenging. And we're putting all our heads together and trying to figure it out. And we'll navigate it with you as best we can. But it's going to be hard. And I think lowering your expectations for returns, certainly not expecting double-digit returns like we got in the last year, is helpful. I don't know for a fact that we'll see low returns right away just because financing is so cheap.
And then just as you go through, if we could just kind of think about the challenges, especially vis-a-vis the one we always talk about, which is staff to implement the collaborative model. You don't have to do that now, but just a little bit, maybe more granular on the specific challenges and how to execute for those.
Thank you, Gail. And, Gail, maybe what we'll also do is just make sure that in the next either update on the collaborative model or update on the Pillars project that Scott manages, we can look at whether, adding sort of a standing item or comment around some of these challenges coming back into the workplace. Some of the things you and Chris talked about could be incorporated there so that you get regular updates. Perfect. Okay, great. Next, we'll go to Bill and then Jennifer.
Thank you very much, Joy. Again, I want to cast an attaboy to the investment team. I mean, you guys and gals have performed remarkably under very difficult circumstances. Where are we in terms of the fiscal year, for the first 6 months from the end of June to the end of December in terms of our return? What is the percentage return there?
Well, it's kind of, I use a baseball analogy, but it's kind of like a no-hitter in the 7th inning. I just really haven't focused a lot on it. Scott, do you have that number at your fingertips?
Yes, I do, Chris. So for the fiscal year up until December 31st, our return is 15.9%. And Chris will kill me for saying this, but we've generated about 1.2% outperformance above the benchmark, and he's shaking his head already. That number can come and go, so I'll qualify by that. How about that, Chris?
Knock on wood, throw salt over your shoulder.
Yeah, keep throwing strikes. That's what I say. And strikes that have no wood on them. Anyway, the other question I have is, and I know this is a question that is really totally unanswerable, but just your perspective on the rotation, but it seems to be a rotation from growth to value in the market today.
Yeah, I tried to mention in the last couple of CIO reports, the just extreme returns of growth and value are just mind-boggling. Let me grab this because I was going to do it in the later report. In 2000 through February, so let's just call it the COVID year, Russell 2000 growth, so small cap growth stocks up 59%. Value stocks are up strong too. They're up 41. But growth stocks are a double on that. The 3-year return for the Russell 3000 value is 8%. Should be, you'd think that was good, but the Russell 3000 growth, 3 years ending February, so an odd time period, 21%. It should revert back. We should see value come back with a vengeance. But what causes that is tough to say. And you'll need some kind of transition. I mean, right now, stable, boring companies that generate earnings are not valued by the speculators. They still prefer these story stocks. So I think we'll see rotations. They tend to be vicious and fast. We're still very balanced value and growth. So we're picking up the good and then waiting for the value to come through. We don't like to try and play, Bill, that value growth split because it's just so hard to call when those dynamics will come in. And for the rest of the board, there's a famous study by Fama French that basically says value wins over decades. But just like Warren Buffett will tell you, you can wait a couple of decades to finally get rewarded. And remember, everybody thought he was old-fashioned, out of date, and useless in 1999. And then he came back with a vengeance. And now, since he doesn't own a lot of growth stocks, they're kind of poo-pooing him again. So I think we'll see value come back, but I don't know what the catalyst will be, Bill, that causes it to happen. Other than right now, it's just sort of trading mentality and, frankly, more speculation mentality.
Thank you.
Keep
up the good work.
Thanks for the unanswerable question.
Great, thank you, Bill. So we'll go to Jennifer and then to Harry. Jennifer, you're muted.
Thank you. The most common words of 2020 to date. In 2021 to date. Anyway, thank you. My questions were actually answered. And I'm sorry I didn't get the raise hand down, but I might just quickly say, another huge congratulations to the team. That's phenomenal performance, both absolute and excess return in such a challenging time. And to have done that, moving to remote and everything else. And then similar to Gail's questions, I would just encourage, as you have, to continue to keep us posted on both the opportunities as well as the challenges as we navigate through uncharted times and do it so well. So thank you.
Jennifer. Mr. Chair, Harry.
Oh, thanks, Joy. Appreciate the report. I always love looking at the semi-annual reports. And Steve, I appreciate the overview from Makita's point of view and your prepared remarks. The document that always captures my eye is the 1, 3, 5, 10, and the 30-year performance. Really trying to keep a focus in on the long run. And in the time that I've been on the board, my observations have been the team has been really incredible at avoiding unforced errors and not making big mistakes, which I think is huge. Secondly is you've really been able to capture what the markets offer and provide, through our asset allocation. And then finally, in terms of the private markets, the relationships that have been established relative to the quality managers and to be able to make those selections in private equity and real estate specifically. And of course, Glenn's work in fixed income speaks for itself over a long period of time. So, we take the singles when they're there, we get doubles when, we have someone who can get doubles, and once in a while the wind is blowing out. And last year the wind was blowing out and we took advantage of it. So keep up the good work. And, it really is the long run. And as much as we like this report, and Chris knows, each July 1st is a new season. So it truly is on to Cincinnati. So because if you look at the funding level with all those returns, we still have a long road ahead of us. But what makes this team excel, I think, are the people and the mission. People are committed to the mission at CalSTRS and the values. And we've got the right people in the right positions. So that to me drives a lot of the performance and the continuity. Just some observations. Thanks.
Thank you very much, Harry. So well said. And I think the other comment that I would just make is that, for some professionals and for some organizations, it would be easy to take a mentality of kind of hunkering down and let's just keep doing what we're doing until we can get through this. We certainly need to keep our eyes on the basics, but to still have Chris and Scott and the rest of the investment team coming to us with ideas, talking to us about opportunities, talking to us about the types of approaches that we can take in order to continue to excel, I think is also remarkable. So thank you for that. Well, there aren't any other board members who have questions in the queue. Stephen, before we have you sign off, I guess I just want to ask, I know you made some opening comments, but anything else that you want to make sure that we are aware of, anything that we didn't ask, given our opportunity to do so during the semi-annual review?
Thanks, Joy. I guess just one thing, and riffing off of Gail's comments a bit. This is a fantastic report, but what really matters is the future. And as Chris alluded to, it does feel like it's tougher now for a variety of reasons. We've highlighted in the past few meetings the challenges of low interest rates in investing and allocating assets. We brought up the challenges of remote work environment and staffing. So I think it's always good as a committee to be thinking forward about the challenges that face you in the future. And I think you all are doing that in a really productive way. That's it.
Great. Okay. Thank you very much. So if there are no other questions for our general consultant report, then next up we've got the team from RCLCO to discuss our real estate semi-annual performance report. So we've got both Taylor and Ben. Welcome. Good to see you both. Glad to have you join us. I think we'll turn it over to you and maybe just sort of a similar approach, doing some highlights from your report and making sure that we've got time for some discussion with the committee. This item is scheduled for 15 minutes. So Taylor or Ben, I'll turn it to you.
Thank you, Madam Chair, members of the board. Good morning. It's great to see all of you. Before we start, just wanted to introduce a new face to you all. Cecilia Galliani is a new member of our team, a vice president on our team who's played a role in preparing much of this material and doing a lot of things CalSTRS related. You'll see more of her in the future. So hopefully in person at some point this year as well. So thank you, Cecilia, for joining us and joining us for the board presentation. With that, I'll turn it over to Ben to make a few highlights, referring to the slides as necessary.
Thanks, Taylor. Good morning, everyone. If we can go to the next slide, please. I'll briefly touch on performance and then turn it back to Taylor to talk about the market. So in short, the portfolio is compliant across the board. The allocations within the range of acceptable allocation is slightly below target. And that's primarily due to The fact that there was less volatility in the real estate market over the past year compared to public equity markets, which appreciated a little bit faster than real estate did. If we go to the next slide, just regarding performance, the portfolio experienced strong performance across the board and across all time periods. Just focusing on the right-hand side of that table there, the 10-year return outperformed the benchmark by 250 basis points, and the 3-year return was even better at over 300 basis points outperformance. And if we go to the next slide, I just wanted to touch on the evolution of performance over the past year during the pandemic. CalSTRS was quick to write down its assets in the first quarter, and then subsequently outperformed in the later quarters compared to the benchmark, which really didn't take any negative appreciation returns early on, and then outperformed or underperformed in Q2 and Q3. And with that, I'll turn it back to Taylor to talk about the market.
Sure, and we're happy to answer any broader questions regarding the market and our house views. This is a relevant conversation, of course, because as was discussed during the general fund performance, it's great that performance has been truly outstanding. Historically, what matters is what's going to happen going forward. We do believe that CalSTRS is well positioned on the real estate side to perform well going forward as well. But just to highlight a few themes. So first of all, we're experiencing and expecting that we'll continue to experience in 2021 a strong recovery, which induces demand for a wide variety of real estate uses and should lead to pretty broad recovery. Helped along in real estate by low long-term interest rates. We might see, as was discussed as well, a little inflation this year as stimulus kicks in, as a lot of demand is expressed, leading to higher interest rates, but still, nevertheless, in a long-term environment. We're likely to see particularly strong demand for industrial, multifamily, a number of more niche property types, such as medical office and data centers, on both the property side, demand by actual users, as well as from capital markets, and then more spotty recovery of demand, again, by both users as well as capital markets for office and hotel properties. And then retail, we believe, really continues to struggle just as consumer preferences change fairly significantly over the next few years. At a high level, there's tons of capital focused on real estate at this point. There's global capital interest in private markets. Real estate is a experienced way for that to be expressed, and we're seeing lots of competition for transactions in the space, particularly in riskier strategies. And so that's the environment in which CalSTRS will be operating. With that, happy to open this up to any questions.
Great, thank you very much, Taylor and Ben. And don't see her on screen right now, but just wanted to welcome Cecilia, the new member of your team. There you are. Hi, Cecilia, welcome. Look forward to working with you going forward. So we do have some committee members with some questions. We'll start with the controller and then go to Gail. Controller?
Great, thank you, Joy. Thank you for the presentation. I guess just as a general comment and something that I know we're kind of facing as we think about what work looks like in the near term and the long term, but as more companies are adopting, kind of telework policies, do you expect to see, I guess, what do you see with respect to, just kind of office space, going forward?
That is the number one question in real estate right now. There are two ways to answer it. One is who's not likely to come back and what percentage of office using real estate does that consume? And the second is what does the work environment look like coming back? So on the first question, nobody's really sure. This requires a bit of a crystal ball, but most economists who have looked at this estimate that somewhere between 5 and 10% of the previous office using workforce is likely to work from home or from anywhere indefinitely at this point. And this comprises call center employees that were formerly in offices, truly back of house employees, where there's clearly been benefits to productivity from being able to work from anywhere. So that has a drag on office buildings, but in particular, Class B or more commodity type office buildings that were housing those types of employees in the future. The second part of the question, obviously, is what does the work environment look like? And we do think we're going to see far greater work from home flexibility than we've seen in the past. The 3-2-2 schedule is something people are talking about increasingly. 3 days in the office, 2 days working from anywhere, and then 2 days off. And as architects and tenants have actually started planning what the office space of the future looks like for that, they find that it actually has no net impact and actually may even increase the amount of office space needed per employee to accommodate that structure. So in other words, you have to have everybody in the office at some point in time,
right?
But you probably need more collaboration spaces in order to really derive the benefit from that. So, in summary, we think that the demand for really high quality office, Class A office, which is what CalSTRS predominantly owns, probably stays flat or even grows over time. We might have a difficult year this year, for example, but that more commodity office probably struggles quite a bit.
Interesting. Okay, great. Thank you. You had on slide 8 a bullet point about urging support for what's called risk-on real estate investments. Can you explain that? Is that like a reference to leverage or just?
Yeah.
Okay.
It includes both leverage, but also I think investors recognize that we likely are at the beginning of a new cycle, and that there may be more time in which to take on value creation activities and construction.
Okay. So how would inflation potentially impact or affect our leverage strategy? I guess just trying to get a feel for that.
Yeah, good question. So couple ways to answer that. So first of all, our view is that there's likely to be limited inflation long term. So, but if there is inflation, it typically benefits real estate, in particular real estate that is able to renew leases fairly quickly, such as multifamily. And CalSTRS has a large share of its assets in multifamily, so it benefits from that from an income standpoint. It also likely makes the debt that CalSTRS is securing today essentially more valuable. If interest rates increase going forward, today, we received a presentation yesterday in which we saw that CalSTRS real estate's for the core real estate, the collective interest rate is just over 3%. Very low interest rates at this point. A lot of that in fixed types of structures, which again simply benefits the overall value of the assets if rates subsequently increase going forward. But something that the team is paying a great deal of attention to, the low leverage side. That's something we wanted to talk about more in closed session to give you a sense of innovative ways in which staff is utilizing leverage to enhance the value of the portfolio.
Okay, appreciate that. Thank you. Thank you, Joy.
We'll go to Gail and then Bill.
Thank you, Madam Chair. I actually had the same question as the controller with risk on. How did distressed assets play into that kind of piece of and is there kind of a huge rush to those assets, and it must be a little bit more of your crystal ball thoughts as to how we figure it all out?
Yeah, Ben, do you want to take that one?
Yeah, I think that what we're seeing is depends on your definition of what distress is, right? So within real estate, to the extent that we're seeing distress with regards to operating performance, that spans certain property types, most acutely with retail, but also certain parts of the office sector, among a few other niches. But on repricing, really, we haven't seen a lot of repricing in the office sector, and also a little, it's very uncertain what pricing is in the retail sector, just simply because there aren't a lot of transactions. And so to invest in distress in the retail sector is a little bit like catching a falling knife. No one knows exactly, what it's going to do or where it's going to land. And so there really aren't those bottom feeding opportunities materializing even in the retail sector yet. That may materialize over the long term. But to invest in retail, you really have to wait until prices bottom or approach the residual land value of the properties, giving no value essentially to the improved portions of the properties.
That's super helpful. I mean, I do think just for the future, given how we're seeing kind of the disappearance of retail in a lot of ways, brick and mortar retail, it would be interesting to understand kind of what that transition looks like. So like what do malls of the future look like? What's in them? Is it all restaurants? And just like what do we see in spaces? This is a really long-term question, but I mean, I think that sort of gets at the answer, right? Like the reason you're not seeing the falling assets is because we're still trying to envision what some of that mixed use space may look like. So it would be good eventually to get a better understanding, because we are really seeing like a whole industry, a whole sector sort of disappear, but stay alive at the same time. So it's an interesting question, I think.
Yeah, there are some case studies on redevelopment of certain malls, say adding multifamily, for example. Just a note on CalSTRS portfolio is that you really don't own many malls, and that's actually helped you outperform the overall index as well.
Yeah. Okay, we'll go to Bill and then to Karen. Bill?
Thank you, Joy. Could you've suggested that multifamily is going to be an attractive place to invest going forward. Could you comment on how affordable housing is an advantageous way to access multifamily? What economic benefits do you have with affordable housing?
Yeah, I'm happy to start on that. I'd really define two primary benefits. The first is that affordable housing always has sufficient demand to fill the buildings. There's limited affordable housing in the United States, in virtually every market within the United States, and affordable projects always have wait lists associated with them. So whenever there's a move out, you can fill that in very, very shortly. So where conventional multifamily runs at occupancies of between 90 and 95%, depending on the market, affordable housing runs at virtually 100%. There's always turnover, so it's a little less, but very, very strong demand drivers. So you can really rely on the income. And the second benefit is that leverage for affordable housing is subsidized by the federal government, as well as sometimes by state and municipal organizations as well. So you're able to secure very low, very secure, long dated, low cost leverage for multifamily assets. You combine those two things, very stable income at the revenue side, because of demand, and low cost of leverage, and you're able to drive both fairly attractive rates of return on an income basis, and do so over a long period.
Thanks.
Well, Karen?
Thanks, Madam Chair. I really appreciate the report, and it's always so full of information. And I think that because real estate is something that's so tangible, it's not an imaginary thing out in space. It's something that we can visit and see and actually enjoy. So one of the things that I wanted to know is that because of the economy, because of businesses going out, because of the property that CalSTRS owns, I don't know if my question is more for a closed session question or not, but how are the rents and the commitments from these owners of these big buildings paying CalSTRS their rent and their leases and being able to meet those demands?
Yeah, we can go into that in a little bit more detail in closed session, but,
okay.
But the short answer is that so the short answer is that that there's few delinquencies, that rent collections are quite high and have been high, especially across the office and multifamily and industrial portfolios across the entire pandemic so far, and very, very little give backs of space. So in other words, high resiliency so far in CalSTRS portfolio regarding rent collections.
Okay, good. All right. So we'll hear more about what the challenges are for that. And then just a real quick basic question. I just want to understand multifamily. Are we talking about apartments? Is that the word that we want to that I would be familiar with?
Yeah, you're right. Multifamily can include for sale and for rent, apartments, but really we talk about for rent apartments.
Okay. So thanks. Just a very basic question. So thank you.
Yeah.
Thank you.
Karen, thank you very much. Thank you for your questions, Karen, and we'll be sure to take up sort of more detail in closed session as a follow-up to your question about rent. So I don't have any other board members in queue right now. I think just before we close out, I'd ask Taylor and Ben and Cecilia, is there anything else that we should know, from our consultants regarding our semi-annual performance report that we haven't covered or that board members haven't already asked about?
Well, I think you're asking about one of the things that we look forward to discussing both in closed session as well as in future presentations, which is this question of leverage and getting into the detail regarding how it can be utilized to enhance returns, as well as what potential risks CalSTRS is incurring by utilizing leverage as well. So in short, we think that you potentially have seen that CalSTRS overall loan to value ratio on this real estate has increased modestly over the past year after about a decade of declining. That's a move we support, but it does increase potential volatility of returns over time as well as if and as asset values change. So that's something that we should discuss. Again, we think everything's being done very prudently, but important for the board to understand. And then second, which again, we're happy to discuss in much greater detail in closed session. The real estate team is leveraging to use the word leverage again, utilizing the collaborative model, I would say rigorously at this point, internally, externally, and so on, to impressive results. And through partnerships with their managers, but also partnerships internally within CalSTRS to be able to pursue asset types that make sense for the fund as well. So again, happy to discuss those in greater detail further on.
Wonderful, thank you. I look forward to having the committee have that discussion in more detail this afternoon in closed session. So thank you very much, Taylor, Ben, and Cecilia. Before we move to the next item, just Samantha, is there any public comment specific to this agenda item 6B?
There are no callers in the queue for 6B.
Okay, thank you. Okay, and then we'll wrap up our semi-annual performance reports with private equity. I think we have 15 minutes scheduled for this portion, and we should have joining us, I think, Steve Hart and John Hegarty. See Steve?
Yes, good morning. We just have a few minutes left of the morning before we're getting into the afternoon. So, we'll look to try to be brief as well. Joined by John Hegarty on the presentation today. And as noted, we have a short presentation today, but our materials also include a little bit more extensive report, which the board can have access to as well. But before going through the report, maybe just turn to the next page here. I'll make a couple of comments on kind of what the year 2020 was like. So as we kind of have heard, it was an interesting year. In all the ways. So it started out pretty benignly. It was a good market, but was not excessively so. It wasn't super hot. But certainly when COVID-19 hit, the GPs turned from doing new deals to managing their portfolio. They went very quickly from that. So new deal volume went down substantially. And they really focused on their portfolio companies, preserving liquidity at those portfolio companies, managing costs. CalSTRS and other limited partners also spent some time really looking at their own liquidity profiles to make sure that they understood how those looked. So, as the COVID-19 kind of rolled through, there was interest and discussion about potential opportunities in distressed debt that kind of came and went very quickly, in large measure to two things. One, the substantial increase in liquidity offered by central banks, as Steve McCord had mentioned earlier, as well as the very strong rebound in public market asset prices. So a number of these things just didn't really materialize in the distressed debt area in ways that people maybe had anticipated looking at 2008, 2009. There was a lot of, as the rebound took place, a lot of things took place a lot of recovery took place in very growth-oriented technology names, and frankly, there were very few bankruptcies that took place in private equity portfolios. So by the end of the year, there was a lot of recovery in the value, and we can see that in the performance that we'll be going through in a couple of pages. The largest and most well-recognized private equity managers were able to raise their funds. And at the end of the day, for 2020, the aggregate amount of capital raised was very close to prior records. And just wanted to also comment here that through this whole process, our observation that staff did a really terrific job. Number one, transitioning to work from home. As we'll talk about a little bit further, they continued to deploy capital to high conviction managers. They continued to ramp up their collaborative model through the co-investments. And they also attracted and onboarded new staff. So really a terrific job all around in 2020. So if we can turn to the next page here, and I'm going to turn over to my colleague John for a few comments, and we'll kind of go back and forth as we go through these pages quickly.
Great, thanks, Steve. I'll talk just a bit about deployment. As you know, the staff ramped up deployment in recent years, and you're starting to see that in your report. You're ahead of the interim target by 2 points, and that's to be expected given the increased pace of deployment, but you're 2 points below the longer term target of 13%. We have revisited our own personal Makita pacing model and reconciled that with that of staff, and it comes out that the commitments of roughly $8 billion per year is what will move the program prudently towards that long-term target of 13%. And the co-investments, interestingly, because they provide immediate exposure, are accelerating some of that move towards the higher percentages of the larger exposure that you see at that 11% figure. Taking up on Gail's theme of looking ahead and things to be concerned about potentially, we're in a strong market for risk assets, as many people have talked about. And so some of the things that are on my mind and Steve's mind are how we can ensure consistent private equity deployment if things change, if the equity markets, the public equity markets pull back. And as we all know, historically, those have been very good times to invest in private equity, but at the same time, very precious times for liquidity for entire pension funds like CalSTRS. So we'll be looking to talk about ways to maintain consistent deployment in such a market, and that could require some policy flexibility on the percentage that private equity might comprise of the total plan, or some kind of guidance on pacing to your private equity staff.
And I'll just make a couple of comments on the portfolio construction. As we note here that buyouts is the largest exposure in the private equity portfolio. That's somewhat to be expected in a program the size of CalSTRS. We note that that's an area where it is probably the most scalable of the sectors within private equity. So it can be the place where additional capital can be deployed relatively sustainably and in a consistent way. That being said, the buyouts exposure is somewhat overstated, out of line with the broader State Street Index. There is more exposure to growth and venture in the State Street Index, and CalSTRS staff is looking to try to manage their exposures and look for additional ways outside of buyouts to invest. So there is, as I mentioned, the deployment into some opportunistic debt strategies. They're looking to add growth-oriented co-investments into their program, where co-investments had historically been more buyout focused. So looking to add some growth exposures into the co-investment strategy. So those efforts are continuing, and we expect those to continue going forward. If I could ask them to turn to the next page. In terms of the performance here, it was a very strong year for the CalSTRS program. We did note that in the 6-month period from March to September, there was a overall net value increase of over $5 billion in that 6 months. Over the long term, the private equity asset class has been a very strong performer. Over virtually every time period, the private equity has been the strongest performing asset class. And while we could expect to see that over the shorter time periods, there's been more volatility. The 1 year, the last time we reported to you was at just about negative 1% 1 year performance as of the March report that we gave you. It is at 16.3 now, so a lot of volatility there. But the 10-year number last time we reported was 11.39% and 12.45% now. So seeing that there had been improvement, but it was more muted in the longer term time periods. Turn it back to John.
Great. What comes with some of these very strong returns are higher prices, of course. So that's on our mind as we look ahead. But the question might be whether those prices are higher than the stock market is. So pricing is very high for private equity relative to its own history, but is pricing very high for private equity relative to the stock market? And in our opinion, it's not. The other thing that we think about as we look ahead, and this dovetails with some comments Steve McCourt made earlier about the stock market, is that we've seen earnings growth as a big contributor to private equity returns in recent years. That's been driving some of the returns that Steve Hart just spoke about. And so going forward, we're thinking about other ways that private equity managers will need to execute in order to continue to maintain those high levels of performance. Focus on cost and efficiency, for example, in ways of improving margins rather than relying upon very strong earnings growth. I'm going to talk a little bit more about deployment on the next page, which is 4, and simply say that in the second quarter, you saw a negative cash flow. This is to be expected, and we have a slide in the future that highlights this for the total program over a long period of time. But the second quarter, cash flow was negative, and it was roughly neutral in the third quarter. And as you are ramping up your deployment, negative cash flow is to be expected as this pace of deployment increases. The other thing I'll note on this page is that the private equity program has roughly a budget of $8 billion to deploy each year. And we show you that the second half of 2020, that the staff committed a little more than half of that, $4.4 billion. So the pace that we would expect for that period of time. And then lastly, I would note that co-investments have been, as you know, a big focus of the deployment. It's targeted to be about a fifth of the annual deployment, the rest being deployment in funds. And staff has been very, very active, not only with researching and conducting diligence on these individual investments, but also hiring the resources and putting in place the governance to handle that higher pace of deployment and co-investments. I'll turn it back to Steve for page 5.
So thanks, John. Here on page 5, just to provide some figures with some comments that we had before, you can see about how the exposures are broken down by strategy. One can also see from there that all of it is within the ranges, so that all makes sense. But just pointing out into the future, you can see that the column labeled unfunded commitments helps give some preview to where the future might hold in terms of what these exposures are. So, in the buyouts area, that it's a very strong number there, over $15 billion of unfunded commitments there. The debt-related has $4 billion. So you can see in all the asset classes, except in venture capital, where it's a tougher class for CalSTRS to invest at scale, but can see that there's not as much unfunded commitment there in that section. So finding ways to continue to get exposure to growth-oriented assets is something that CalSTRS staff is looking to. And in some cases, they're really looking to emphasize that more growth equity strategies, which can be, more rolled into the buyouts exposure at the end of the day. One other comment I make just quickly on this page here that we would comment to, and this relates to some of the presentations we've had from some speakers, and that is having to do with non-US exposure, particularly in Asia. Certainly expect that in the future, Asia will continue to become a larger and larger percent of the opportunity set. And for CalSTRS to continue to be vigilant about seeking to understand and make selective exposures into that marketplace. Staff is doing that. But we expect that to be an area of continued emphasis going forward. So turning to page 6, I think that we've made all the comments on that page. Asked to turn to page 7, and I'll turn it back to John.
So on slide 7, I'll just call your attention to the red line. There was a period of time from 2011 to 2017, a 7-year period where you're receiving more in distributions than you were making in contributions. So the net cash flow was positive. That turned negative as we expected it to in 2018. And our cash flow modeling is suggesting that might continue for another couple of years. So roughly 2023 might be when that turns back to positive. And Steve, back to you on slide 8.
Turning to slide 8, so here are the performance figures that I touched on previously, and you can see that really across the board, the performance has been quite strong on an absolute basis, and then on a relative basis against the various benchmarks there, with just very close on the 10-year total performance there. Would say, as I mentioned before, that we really end up wanting to focus more heavily and encourage the board to focus more heavily on the longer term timeframes, the 5 and 10 years, as the market volatility, as these assets get marked to market in the 1 and 3 year can be relatively driven by that, as opposed to really giving the tale of how the portfolio is overall performing. Turn to the next page, and then I think that we're made the comments there about the performance, but I think that really encapsulates our discussion today, and happy to take questions from the board.
Great, thank you very much, Steve, and thank you, John. Let me see if there are any board members who have questions. Let's see, we have a question from Gail. Gail?
Thanks, Madam Chair. Just a couple questions. One, just on the, I was actually really concerned about our pacing. So two questions. One, just on process in terms of pacing, because we're a lot farther ahead than where we thought we'd be. I assume that's a good thing. I just kind of want to double check that with you guys and make sure. Second, I'd like to better understand this issue of how strong our commitments are in buyouts, kind of everything included in there. And if we do need a little bit more of a balance between buyouts and all the other classes, maybe venture's not possible, but should there be something else we're looking at given the really high distribution we have in buyouts and the high call we have there too? So if I could start with those two questions, and then I have one follow-up.
Sure, maybe I'll have John just do the first part, and then I'll take the deployment question.
So first on the pacing, there's nothing alarming at all about the 11%. That's exactly where we want to be. And in fact, it's been a strong initiative of the staff to get close to that 13%. So we're at about 11. It's notable in that it is past the interim target, but there's a reason why it's called an interim target, which is just to acknowledge that you can't go there immediately. So no concern whatsoever with that. I think it speaks to a lot of good work. And as you get closer to your target in any private market asset class, there is more of a risk that with a downturn in the public markets that you're a little bit over allocated. And that's what I was alluding to as we think about making sure that we have thought it through and we react correctly to any such circumstance, and this so that deployment remains consistent.
Mm-hmm.
If you get up to that 13% or closer to it, where stock market decline would have you bumping up against your upper bounds. So it's a good thing, and it's you're still 2 points below your longer term target as it is now.
Okay, so is there any point where we'd want to consider actually an increased asset allocation in this regard? I'm not advocating for that. I just, exceeding the interim benchmark doesn't at all speak to kind of going higher overall, right? Like there's no correlation there necessarily, at least not now. Is that what I'm hearing you say?
Interim target, this is at Chris's level. Why don't I see him chiming in here. Why don't we let him answer that?
Thanks, John. The the overall investment policy has a plan to get to that 13%, increasing 1%. We look at it basically every December 31 and every June 30. And staff has already started talking about whether we'll be needing to make that adjustment this coming June 30. The next meeting's in May, and normally you'd want the policy ahead of time, but being concerned, you've got 2 full months. And a lot of the weighting in private equity, frankly, actually has to do with how the public equity market is doing and fixed income, because that really changes the denominator. So we'll revisit both private equity, RMS, and real estate and inflation-sensitive allocations at the July meeting and readjust the interim benchmarks at that point.
That's helpful. Thank you.
And then just on the deployment question there, Gail. Staff is aware of the somewhat over allocation to buyouts compared to the State Street Index, and recognize that's as I mentioned a bit related to the scale that CalSTRS has as being one of the largest deployers of capital in private equity. So some of these smaller strategies are just not accessible. These smaller managers are just not accessible. So how to address that? So there is ways that they look to do that, as I mentioned, deploying into the opportunistic debt and other ways of adding capital outside of buyouts that might be value play at that point. Looking at growth equity managers that they play a little bit later stage in the development of portfolio companies than pure venture capital, but it's a way that can get a lot of that bang for your buck, getting that exposure. And I'd say that they continue to work with other vehicles. So they have some fund of funds that get them exposure to smaller managers, and they work through that as they can make a deployment to some of their fund of fund managers in the diverse and emerging manager categories that allow them to do that and have that manager deploy that capital into the smaller managers. So they are conscious of this and looking at ways to try to mitigate that exposure to buyouts. And then lastly, on the co-investment side, so I mentioned it. So it's a place that they spend their time and thinking about as they think about their portfolio construction.
That's super helpful. I would love to maybe, if we could, Chris, I don't know if it's at all possible, just get maybe in closed session, you'll be giving more detail on that, but it would be nice to understand. And then just my final question on private debt, and just this question we asked under the real estate section, and just leverage and private debt. I would love to learn a little bit more about those as opportunities. Right now, I think it kind of fits in with our private equity portfolio. I don't know if it is a separate asset class and how we're thinking about that. And if that, in terms of allocation, is it all something that we should be considering within the allocation as another opportunity? So that can be obviously a future conversation. Just for forward looking, to make sure we've covered sort of, if we are over leveraged in one area, how we're going to account for that.
Sure, and happy to go into further details on that. As I think that been some discussions that private debt encompasses a lot of different strategies, and there's a big range there, and there's some that we would certainly consider be, kind of like private equity, where it's distressed for control, where a manager is looking to get control of a company through the acquisition of the debt and converting that in through bankruptcy, other processes to get control of a company, versus making a vehicle that makes performing loans. So I think that within CalSTRS, there's places where the private debt strategy might fit into a couple of different buckets. I think that we're working with staff and Chris and Scott to make sure that all the areas that are appropriate for CalSTRS are picked up in the places that it makes sense for that to be.
Thank you. And then, Madam Chair, just one, as you suggested, because so much of our incredible performance in private equity is the co-investment and the skill set that our team is building, just again, kind of an update on recruitment and making sure that we have folks to fill that. I don't know if we're kind of at a baseline where we've just filled positions we have, but just making sure that we continue to really support you in getting the skill set that you need to make sure that we can continue on this incredible trajectory. So again, future question, but just to make sure we can have the updates and then also just know how that's going.
Sure. No, we'll report back. And good news is our budget is being heard by the legislature and passed through yesterday, another budget hearing. So things are going very smoothly on the 5-year budget plan.
Great, and I think the other thing that we'll do is, some great questions this morning, and again, I think we see some themes kind of weaving through different asset classes, as you just raised, Gail, with sort of looking at private debt, and I think it's sometimes a challenge, especially in the meeting environment that we are in, and the limited time that we have with each other to figure out how to bring these to the committee. But perhaps working with Harry and Chris and Scott, we'll continue to figure out the best ways to both keep the committee apprised of the kinds of opportunities that staff is looking at, as Steve has mentioned, but also an opportunity for either regular updates on the collaborative model and staffing, but also if it would be appropriate to have sort of a bigger picture, sort of step back look at opportunities across asset classes, so that the committee could be aware of those. So we'll take that into consideration and try to figure out how to slot it in at the right times. Great. Okay. Well, those are the only questions that we had for Steve and John. I think Steve or John, just before I let you go, the same question that I asked the other consultants. I think you were able to give us a number of highlights from the presentation. We had some discussion around Ms. Miller's questions. Is there any, and we'll have some additional time in closed session, but is there anything else that you want to highlight for us before we complete this item in open session?
I'll just add, one more comment here. It's something that virtually all private equity investors struggle with at the end of the day, is that the opportunity set that you have at any one particular time is reliant upon what those underlying general partners fundraising cycles are. And being able to deploy capital in a consistent way, which is a fundamental underpinning of being able to reach the targets. Finding ways to be a partner of choice, to be able to deploy capital in multiple ways is an important undertaking that CalSTRS, I know, is working on and looking to try to be that for the general partners, so that even when there is interesting opportunities that are available, but it's outside of a fundraising process, that CalSTRS can be an early and first call. So that's something they continue to work with and work on, so that the deployment of capital is not so tied to a relatively pro-cyclical fundraising process.
Great. Thank you very much, Steve. So before we close this item, just I'll ask Samantha, are there any callers in queue for public comment on this particular agenda item?
There are no callers in the queue right now.
Okay, great. Then I think what we're doing at this point is we are going to take a break. Appreciate everybody on the committee being able to stay on a little bit longer than we had scheduled. Our break is until 1 o'clock. And then what we'll do is we'll come back into open session with our CIO report from Chris and team, close up our open session, and then we'll go into closed session. We'll open up at 1 o'clock. So I just ask everybody to get online 5 or 10 minutes before that, so we can start promptly at 1. All right. Thank you, everyone. Okay, good afternoon, everyone. Welcome back into the remainder of our open session of the Investment Committee meeting today. We'll start with agenda item number 7, which is our CIO report. So I think we've got Chris Ailman that'll be presenting. And just for everyone's reference, this item is scheduled for 20 minutes. Chris, we'll turn it to you.
Thanks, Joy. And thanks for bringing up the PowerPoint, Jonathan. If you can turn the page. I've changed the PowerPoint to match the report that's in the written materials. Hopefully that'll be more efficient for the public and for the board. I want to point out the board's aware the assets actually touched 290 billion in the middle of February. So very remarkable. We had to sell off a little bit in the end of the month and so far here in March, but all-time record high of 290 billion. Just remarkable for a year with the stay-at-home order and COVID. Next page. Here's the asset mix. So instead of a pie chart, we're going to more of a bar chart and the area chart. And the purpose of using that area chart is really to show you how stable the asset allocation is. We don't try and time the market. We don't try and make big allocations one way or the other. The orange or yellow at the very top, or tan, depending on your colors, is cash. So that can tell you and show you where kind of the cash position is. You can see when you saw the downturn in February a year ago, we increased the cash allocation in anticipation of volatility and concern. You can see the pink, which is inflation sensitive, continued to grow and enlarge. We actually can take this graph back all the way to the 1980s. And it's kind of fascinating how volatile CalSTRS was in the asset allocation in the 80s and 90s, but starting in about 97 through now 2020, for the last 23 years, it's been very stable. And we have really not made big asset allocation swings. You've seen assets grow and increase over time, but we still remain fully weighted in public equity. That is still our largest asset class. And so we've got some graphs that focus on the risks there. Next page. So here is the measure of the risk of the global equity portfolio, the active risk budget, currently at 33, and you know the range is 10 to 50. June's made some shifts in the portfolio so that we're taking less active management in some of the areas where it's not as efficient and put that money in passive, but then increasing our exposure in active management where we think it has a better chance to make a return. So very static and within budget. Next page. So this is going to be a topic that is really going to drive our discussion is fixed income. And this is at least a snapshot for you of the forecasted active risk within fixed income. As Scott mentioned earlier today, we're going to be coming back to you in May with a risk budget proposal for both fixed income and for CIS. Historically, fixed income has been very tight to the benchmark, and the active risk has been very, very low. It jumps in March simply because the surrounding volatility of fixed income when interest rates went back to zero. And so not that Glenn made a dramatic change in the portfolio, but that its surrounding environment shifted. And you can see it still remains elevated because of the volatility we're seeing in fixed income. Today was another day. A lot of expectations about what Chair Powell might say today. As Glenn described it, there was speech A or speech B. The market was rooting for speech B, but they got speech A, and that's what spooked the equity market. I think we're settling down a bit at the close, but we're still down 350 on the day. Next page. So here are the sources of risk within our portfolio. Obviously, public equity is by far and large the largest exposure. And then you'll notice the real estate and the private equity, and then finally foreign currencies and other. Other jumps dramatically in February of last year, and that really increases it. And then obviously the huge increase in volatility in the public equity market from last year. But you can see how it's slowly, steadily settling down. We've seen some volatility of late, but we're not seeing those days at all where the market hits trading limits within the first 10 minutes of trading. And we'll decompose these as we get more data on what we call other, but it is still a fairly large segment of the portfolio. Next page. So when I climb up the crow's nest and look out there at our risks, obviously the pandemic, first and foremost, variants, mutations of that are going to constantly grab the headlines, and then the vaccine rollout. It looks like we will probably get more government stimulus. That means probably more Amazon Prime trucks driving around everybody's neighborhoods, because it seems that consumers aren't spending all of their stimulus. They are increasing the savings rate. The savings rate has shot up to double digits, which is the first time in decades in America. Normally, we tend to be at very low saving rates, but it's interesting in the generational shift that millennials and Gen X do save some of this money, which is wise. The big discussion in the markets is inflation. It's clearly in check by most measures. I think we're starting to feel and see inflation in certain areas personally, but the basket that the government uses to measure is not rising, which I have to point out does include inflation expectations. So sort of expecting inflation causes inflation. We'll see, commodities have really risen, things like lumber. Copper have gone up dramatically. Oil is now, if I look at the screen, up at near $64 a barrel in West Texas Intermediate. So some of the commodities have risen. There's still such a slowness in the economy. People don't perceive inflation, but that's a bit of what they were expecting Powell to comment on, and he didn't. And I think that's what's causing the climb in rates here near term, is the concern that rates may be higher if inflation increases. Next page. So inevitable surprises, who knows if we're going to be hit with another pandemic. It sounds like the wintertime went okay through particularly Asia. Boy, we have certainly seen the climate extremes. Texas, now there's more flooding forecast for the Mississippi Valley region. All of these risks still stay out there. I raised North Korea only again because the sanctions put on the country seem to really, really be crippling it. And their only solution to the sanctions is to do something outrageous. So That'll just be a risk that we'll have to continue to monitor. And last page is done with my PowerPoint. A couple things I want to highlight before I open it up to questions. There was a comment today in the public comment, and I doubt they listened to the afternoon, unfortunately, but one of the people in the public comment mentioned that you make divestment decisions for moral reasons. I want to clarify, obviously, none of us were around in 1987 when they made the decision to divest in South Africa. Actually, Alan Emkin probably was, but I won't tax Alan's memory of whatever that was, 30, 40 years ago. But I can tell you that all of your divestment decisions since the year 2000 or 1999 have all actually been investment decisions. They are not moral decisions. That opens a can of worms, as Brian would tell you from a fiduciary standpoint. You are managing other people's money, and your morals, are going to be different than theirs. So divestment is absolutely an investment decision, pro or con. We're still going to be faced with that challenge of their appeal for us to divest. They believe it will cause the major oil companies to lose their social license to operate. I will let you debate whether you believe that connection can be made. One thing I will say, and I'm empathetic to listening to their comments, we want to change and protect the climate as well. And somebody made the comment that we should listen to Al Gore and David Blood. I actually had a conference call with a global group of CIOs with Al Gore, and he and I personally talked about divestment and about the future. And it's the realization that, people are making goals of net zero by 2050. I said the reality is that the world is really going to need to be net zero by 2040 or even earlier. And I think the recognition is coming that more needs to be done. You made an approval today to do a very sizable investment into sustainable climate solutions in the future through the CIS portfolio, both in the public markets, which we had the ability to do, and now in the private markets. So we're going to be a very important source of capital around the world to bring out climate solutions. And we'll do a better job of making the membership understand that and know that. And I guess one thing, and just a personal note of observation, I think we all wish that a simple boycott of something could bring about social change, but you have divested of certain industries for decades, and it hasn't amounted to any force of social change. So there's a disconnect in the understandings of the capital markets and how things interact. We're actually both on the same side with the public comment and the membership of concerns about the environment and trying to protect our way of life and protect the planet, as well as diversity and equality. It's just different ways about going about it. So with that, I will open it up to any comments or questions you might have.
Thank you very much, Chris. So we'll go ahead and start taking questions from the committee. The first one I have is from Gail.
Thank you. Thanks for that, Chris. I just wanted to ask one follow-up from the last time we had this discussion, and that's about including income inequality as a risk. I
did not include that. Yeah, no, I didn't include that in the chart, and I need to do that. When I talk about social unrest,
that's what I was afraid of. Can I actually maybe stop before you finish that sentence?
So sure.
There's a lot that happens with income inequality that is not social unrest at all. So I really want to caution us from thinking that the historical tales, if Alan's on about South Africa, I mean, there's so much that happens with income inequality before it gets to social unrest. So I don't know that, I think there is a risk that, that what happens when people can't pay their rent, not that it leads to social unrest, that it leads to kind of a bottoming out of the market. So it is really distinct from that. And I'm sorry, I cut you off. I actually did that just so we didn't have to get into a debate. So I would just respectfully disagree with that.
No, I understand. So what you're saying is that it could lead to a recession, depression.
Yeah. And then, what happens, and I think this is really something to be thoughtful about, what happens if we continue to be this uneven, the people we're serving are actually, not necessarily benefiting from these like unseen returns. And I just want to be cognizant of what happens when folks can't pay their rent. What does that mean for affordable housing? What does that mean for the demand for affordable housing? and benefits and other ways that kind of the social contract of government, we really have to figure out how we in fact figure out how to pay for that, and that can be a risk to the fund as well, because to the extent we rely on the general fund as a backstop, all of those questions I think become really important for our fund, not necessarily global economic trends, but certainly for our fund in particular. So I would specifically add that. And then I'll just kind of defer to our previous caveats around just the risks around private equity and how we just have a better way of not just knowing it's a risk, but how to really start thinking about that as a board. And I know we're having those conversations, so I'll just say that to you at this opportunity as well.
Okay.
Thank you very much, Gail. Our next speaker is Harry, but before I go to Harry, Brian Bartow, I saw that you popped up on the screen, and I just wanted to make sure or find out if there was anything that you wanted to add. I think it started with Chris's comments around our fiduciary responsibility, and just offer you the chance to provide more input to the committee.
Thank you. Yeah, Chris was exactly right, and I popped in to really support and perhaps give more detail to what he mentioned. Each time that you've made a decision to divest, you had a divestment policy, and it really was a laborious process, and there was a lot of information presented, including the financial implications, and decisions were taken after a lot of deliberation and very, very prudent review. So I would just emphasize what Chris said. It wasn't a moral decision, where there may have been moral outrage on some of the initial comments and initial discussions. The process was very, very detailed, and it's all in the public record.
Great. Thank you very much, Brian. And thank you both to you and Chris for raising those issues. I think it's just important that we make every effort for the members of the public and our teachers to know the facts about how the board operates and what our fiduciary obligations are. So thank you very much. Harry, I'm sorry that I kind of disrupted that. I go back to you for your comments or questions.
Of course, Joy, no problem. I just wanted to lend my, support to Gail's comments on income inequality. It's not to say that I or we have the solutions to many of these problems, or certainly does not directly go to our mandate to generate a 7% return on our duties and our responsibilities of fiduciary duty and paying the benefits to the educators of the state. But I think this year in particular, the global pandemic and then the social unrest that we've all lived through has kind of, I believe we're at kind of a little bit of an inflection point around inclusive capitalism. And that capitalism as a system has worked really well for some of us. But the growing gap between people that own assets and those that don't is growing wider and wider. And people who are a lot brighter than I am and who have different, certainly, experiences have raised the same issue. So I think on a forward-looking basis, there might be opportunities for us to amplify our voices around the issue of making sure that this system of capital is actually, as Ray Dalio says, we need the pie to continue to grow, but we also need to do a better job at distributing it. And that's across workers' rights, creating jobs for the future, essentially that we're all interdependent on each other in a system that continues to, benefit some at a disproportionately greater scale than it does others, has probably some existential threat. And this is not the appropriate time to raise it and to try to resolve it. But I did want to lend my support to Gail's comments, because I do think it is a risk that's quite real. And we don't know when, we're at a tipping point with climate change and climate risk and opportunities. This is another risk that I believe is very, very real and front and center. And we've experienced it a little bit too close to home this year.
And Harry, the only comment I'll make is I absolutely understand the challenge is how do we make an investment that generates the return we require and helps solve or reduce the problem. Our ears are open. We certainly have had people come and pitch us that their fund or their new opportunity is going to do that. But the proof obviously has to be there. People have not developed a positive return solution that we've seen to make it an investment opportunity. It often involves subsidies and more of a foundation or private capital to be a subsidy environment to help solve some of those problems. So it's a real challenge, and absolutely agree. It is a risk to the capital markets and to our portfolio.
Thank you, Harry. Gail, I think maybe you wanted to round out the conversation here.
Yeah, I promise. 2 seconds. I think, Chris, I just want to maybe not, I don't think we're looking for a solution to the risk. We just want to acknowledge that it's sort of a macro risk. And I think even, Secretary Yellen has spoken to this as a risk to the economy writ large. So certainly don't expect us to solve it here at CalSTRS. So that I think it's the same risk as sort of a pandemic or North Korea, none of which we have any control over, right? So totally agree with you, not an investment direction at all, just a concern that if we're aware of it, as we're making decisions on asset allocation, we just know that these are one of the things that we can't control for.
Gotcha.
Well said. Great. Thank you. Thank you, Gail and Harry, both of you for your comments. And then Chris, I think what we'll do is just make sure that in your subsequent CIO report, there's a good way to address that as among the different risks that we see on the horizon. Great.
Definitely.
Okay. Any other questions for our CIO on his report? Okay. Samantha, are there any callers in the queue for this particular agenda item?
There are no callers in the queue.
Okay, great. All right, well, we're winding down on our open session. So agenda item 8 is a review of information requests. Scott?
Yes, Madam Chair, I noted 2 potential requests that I wanted to confirm with you. One, a request for a further discussion regarding the tension and challenges between ensuring benchmarking precision while at the same time mitigating complexity. And then another request that for the next update on the collaborative model to add a standing comment on challenges to transitioning from a remote work environment back to the workplace. Did I capture those correctly?
I think so. Those sound right to me, but let me see. Harry, have a comment?
Yeah, thanks, Joy. I just want to be sure that my comments earlier in the day don't fall through the cracks around the benchmarks. And I don't know where it lands, whether it comes back to this committee, the full board, or the comp committee for 21-22, or a subgroup of the comp committee for next year. But a comprehensive look at benchmarks with the hope of either, just a comprehensive overview of the benchmarks, the issues that we've heard for several years now in terms of the complexity of the benchmarks and the number of benchmarks that we have. And it just amplifies the point, the amount of time we spent speaking about benchmarks earlier this morning. I just don't want it to be an information request. It's a direction for all of us to follow up on into the 21-22 year.
Right. Yeah, so I think, Scott, maybe the way to reflect it is I think that your first comment around benchmarks, I think were specific to the agenda items in which they arose. And I think that Mr. Keeley's comment is one that maybe we'll have to take up with the leadership of the investment branch, our board chair and vice chair, I think, I think our board vice chair is the chair of the compensation committee. So we'll just need to figure out the appropriate way and timing to look at that as we go into our next year.
Very good, thanks.
Okay, great. I'm sorry, let me pause for a second. We have Jennifer has a comment. Jennifer?
Thank you. And I'm not sure if this belongs here or the next item, so please guide me. What I wanted to ask is within the RMS discussion when it comes back, if I had a couple requests, do I add that here, which is following on from the earlier discussion, or should I note that as part of agenda item 9?
I think that we can, Scott, is it okay if we take it up here? This will be, I think, Ms. Erden will indicate if there are some specific items or questions that she has regarding what was agenda item 5. I think that agenda item will be coming back in May, and what I think I'm hearing is that we'd like to have potentially have some additional issues be considered or discussed as part of that item when it comes back. But I see Brian pop back on the screen, so maybe.
Thank you.
Brian will correct me. Brian will tell us the right way.
Here, sorry. Thank you.
Scott's the expert, and I didn't mean to. I just thought I'd jump in and say this is a perfect opportunity to put those in the information request. I think this is, there's no magic says you have to do it at the time the item is discussed. So I think it's a great opportunity, which is what Scott was going to say.
Absolutely.
Terrific. Great. Thank you. I just very simply, I would like to ask as we come back with the RMS item for the second reading, that we understand from Makita some further thoughts on simplifying the benchmark really to get the heart of what the allocation is seeking to do, and also recognizing implementation considerations, whether the sub-strategy buckets might either be relaxed, with more discretion and or defined differently. And then also for the staff, just a little bit more on the tightening question of the, leaving the ranges where they are given market action versus tightening them as was suggested and recommended. Thank you.
Very good. I'll note that. Thank you.
Okay, great. Thank you very much, Jennifer. And so I think what that means is sort of in the same way that we had the first reading of our CIS private portfolio discussion in January and had the staff take away and do some follow-up on that and then present it at the next meeting. We would do the same. It's the same approach that I think we would be taking with the RMS policy, which is it'll come back, but we'll have a chance to explore it a little bit more based on some of the questions that the committee raised, including those that Jennifer just raised. Okay. Let me see. Sorry here. Okay, anything else for agenda item number, sorry, I'm losing track here, number 8. Okay, Samantha, anybody in the queue for agenda item number 8 for public comment?
There are no callers in the queue.
Okay, great. So then agenda item number 9 is our draft agenda for the next committee. Chris?
I just highlight that we have several different policies coming back for first readings. Again, just like before, if you have questions, then it'll come back in July. If you can't approve it, then that's great. We'll put the RMS. I had it on there in consent, assuming, but we'll put it on the regular agenda since we had some additional questions. So we make sure we answer those.
Okay. Anyone have any questions about the agenda for next for May? Karen, I see you raising your hand's not on here, but
there it goes.
There you go. Okay, go ahead, Karen.
Just a kind of a silly comment or whatever, but I noticed the location of the May meeting. Are we hopeful?
I think that was just carried forward from the prior agenda. I assume that we will be virtual. We hope the vaccine rollout's that good, but I don't know if the uptake is going to be as fast.
Okay.
So I think you can plan on us virtual, but that's
all right.
Small.
Okay, thank you. Just a little brevity.
That was a good catch, Karen. Okay. Let me see. So I think then that's the last agenda item that we have for open session. Samantha, is there anybody left in queue for public comment?
There is nobody in the queue for public comment.
Okay. Okay, well then with that, I think we will be recessing, or I'm sorry, not sure what the right term is. We'll be ending open session at this point. and leaving and then logging back into our closed session. We're just going to go ahead and pick up right when you log off. So if people could log off here and log into closed session, we'll get started. Okay, thank you, everyone.